Hi, Natalie.
Oh, hi, Ian. Oh,
Hi, how are you?
absolutely zonked. We've been doing so many furlough claims. I'm
Oh,
deaf of it, Ian. It's
ee,
gone crazy, literally.
I can imagine. Oh, yeah.
Everyone's sort of jumping up and down. Oh, have you done it yet?
Yes.
Well, it's just, some of the clients have just literally been, I don't know, you've just seen another side to them, I think.
Oh, wow. Oh, no way. Hi, James. Hi, Hannah.
Hello.
Are you well? Are you also in the furlough? Hannah, I know we haven't. Can you hear me, Hannah?
Yes. Can you
Oh,
hear me?
I can hear you. I can hear you. I can hear you. Hi, Dudley. Yes. Hi. Yes. Hello. Hi, Dudley. Can you hear me?
Hi, Ian. Sorry, yes.
That's
I've
fine.
had a load of problems with my computer this week and have to re-download Zoom. So
No worries. No worries. I'm glad we're still even working in terms of in terms of just connections and. I was even sorry. It was Hannah. I was going to say Hannah. So I mean, I know we haven't seen you yet or met you, but are you in practice, Hannah?
Yeah.
Okay, right. Are you in a general practice where you're able to do some general accounting work, some general audit, some general tax, or are you specific to a particular?
No, it's a really small firm, so we kind of do everything, but we're a
Yeah.
non-audit firm.
Okay.
So
Cool.
my main job for the first year was tax return because the tax return lady had actually left.
Right.
So I was pretty much solely on tax returns, and
Okay.
then in the last 2 months I've been doing accounts.
Okay. Okay. Good. So you're right. So you're not really. Are you? So, but because you'll work together, are you sort of in the middle of the furlough sort of?
Yeah.
Right. So therefore,
Yeah.
we pulled you back in to do some furlough, to some catching up on the furlough stuff. And James as well. James, I know you're in practice. Are you doing furlough work as well, or just?
No, we've been furloughed.
Oh, you've been through that.
Yeah, we've already been furloughed, so we're not working.
Oh, your
Yeah.
firm.
Oh,
Yeah.
Oh, interesting.
that's
But then,
interesting.
how do you deal with the clients who need furloughing?
God knows.
You know what? We're as busy as ever now. It's crazy.
I know. But yeah, we were just told to go home, and I haven't heard from them since. So, but they're still paying us. So
I think I suspect what's happened. They've kept the managers. Your managers must be doing the work, probably.
but they've literally furloughed everyone.
Oh, God. Sorry, it's not. Don't laugh.
I know. I agree.
Oh my God.
Sorry, yeah, don't forgive me. I'm just going to get to the. It's just the fact that you have clients who would be coming back and saying, "How are you going to deal with our work?" But it's. I mean, yeah, they must have then outsourced or someone. The senior partner, the senior partners must be working on the work itself.
Well, Christ knows, but we're not going to have any clients left if they're not.
This is what I'm saying.
Oh, Jesus.
Oh no way. Yeah, this is a tough period. This is going to be really this is going to be very, very interesting. Sorry, I'm just in shock at what James has said. I just didn't think any accounting firms were going to.
No, we haven't heard anyone yet. That everyone that we've been speaking to, they're absolutely snowed under.
Yeah.
Yeah, this is where yeah, because I kind of thought this was kind of a disguise, a blessing in disguise for accountants, because it's there is work, but there is work. I mean, you can, fair enough, whether or not we'll get paid in time is the issue, but we'll just direct debit them, take our money as we go. Anyway, okay, cool. Well, good to catch you guys. Thank you for last week. It's just such a, what do you do? I mean, I know definitely. I know that Natalie has kids. I don't know, but I know Dudley and James don't have kids yet, or that they know of. That's what I asked someone in my class on Wednesday. Do you have any kids? And he said, none that I know of. And I was confused. trying to get that. I was thinking, do you mean, he's like, I think he says no, and it's just a joke. I was thinking, all right, sure, sorry. Right. Okay, great. Let's carry on. We're in a good place. I mean, for audit, the material isn't. What we're doing is, over the time period we have for exams in September, we're okay. It's one of those kind of, I never thought I'd get this sort of time to get a 6-month period to teach audit. So it's more a case of helping you retain what we're studying. Oh, yes, retain what we're studying. Graham, sorry, I just remembered. Yes, I did message you. I put Graham in the email as well. Retaining, let me just check to make sure he's not right. Retaining what we're studying over this period of time. So what we're going to do is we're going to carry on with the next chapter, but what I would like you to do is, you see, because the chapter we're doing today is planning. And when we go through planning, I mean, it's a big chapter. We'll see. I will try and finish it. I'm not worried if I don't. Doesn't really matter. But whatever happens, what I really would like you to do is, because you see, the next chapter is evidence, and that's where it starts to get interesting in terms of the actual work that auditors would actually do. So there's no rush per se to jump into that. What I would like you to really do is to kind of go back and make your notes. That's a really key thing with audit. Make your notes on the first 6 chapters that we've done. Make your cards, really have good notes, because you and I know that, imagine you're coming back to look at all of this in August. You want to have good notes. You don't just want to be reading from the textbook as well, but you want to have your notes that you've made over time. So we're in good stead. What I just want to do is, thanks to those of you who sent me some material. What I want to do is, first of all, really quickly, is just that just to highlight language. So I just want to take you to a piece that, don't worry, Natalie, I know I'm going to use your TYU2 that you sent me. I'll just share that with you all now. For you to see. Share screen. Right. So in the audit risks, for audit risks, the chapter on risks, I asked you to do TYU1, TYU2. I could have done TYU1, but if you, in your textbooks, if you go to page 119, what I want to do now, gradually, step by step, is kind of put you into the framework of an auditor, in the mind of an auditor. And the reason I wanted to I picked this one in particular is that I want you to always think of risks from the point of view of your financial statements, the validity of the financial statements. I mean, Dudley, I read your work. I thought it was quite good. I mean, yes, you did stray into sort of wanting to help them, but we're not really wanting to help them. I mean, that's the beauty of being of audit work. We're independents, technically. I mean, we do make recommendations, but recommendations to the controls, not really, unless we were given a separate engagement to kind of and of course we do help, but that's not what the contract is. The engagement is not for us to come and give you business advisory. So it's very much to see whether those numbers are true and fair. So if you look at that page 119, it's so that I'm not flicking through too many pages. Those numbers, the argument here is, am I happy to sign? In fact, what you're really testing for, what should be at the front of your mind, the professional skepticism that you should have, the suspicion that you should have, is, are those numbers too high or too low, depending on what is likely to be high and to be low. So your mindset is going in there. When you look at page 109, that page 119, you're thinking straight away, I suspect that PPE, property, plant and equipment, will be higher than it should, overstated. So any analytical procedure you carry out, and we carry out analytical procedures before the audit, during the audit, at the end of the audit, is always testing whether or not these numbers are too high, for example. website development, should that even be in there? Because there are standards that tell us that you probably should be putting that, depending on whether it's research or development, you should be putting that through as an expense. So you putting in there makes your assets look better. So by you working out current ratios, you can see here that the one I've talked about, I think probably the most notorious balance in the statement of financial position is inventory. Others might disagree, but I think it probably is, because there's so much going on in inventory, depending on the nature of the industry. If it's a manufacturing industry, they have raw materials, work in progress, they have finished products. There's the question of lower of cost and net realizable value. There's the question of standard costing. So there's potential for inflation in those figures. So whenever you finish writing, if you're analyzing and someone's asking you to carry out audit risks, your final sentence in any risk question, in any risk sort of picking up in what the risk is to say literally, well, the risk here is that this thing is overstated or understated. That's where you're heading towards, really. And typically inventory and trade receivables. I mean, again, I'm only going through this so that because for me, there's no rush per se, because now when you go back to start making your notes on chapter 1 to 5, your language will change. Audit is purely language. Your language will change by the time, and we get a question on audit risk. We get one. We know we get one. It's like I think it's a 20 marker. Yeah, so a 4 marker for the little one, and a good clear, we know we're going to get a question on audit risk. Scenario, bring out the audit risks, discuss. And it's not audit risk, is just asking us to look at a set of financial statements and highlight where we think, based on some analysis, where we are concerned. Trade receivables, that 2040 for 2000. So the key point is, between one year to the next, the fact is that if it suddenly goes up from, if I see improvements, I know you might be thinking, Ian, why are you so, but that's just my job. If everything's improving from 2003 to 2004, well, I'm sorry, I'm suspicious immediately. It is possible, great stuff. You were able to, maybe there was excessive demand. When I say everything's improving in terms of revenue in particular, but already, I'm sure, from your financial statements, when you prepare those things, I'm sure you remember that generally when prices increase, when you're able to sell things for more, unless you're selling in an abnormal market where somehow people haven't caught on. So, because think about it, if I suddenly come along and I start buying these raw materials from a supplier because my demand is going up, for some reason, or I can increase my prices. So say, for example, I don't know, people hear news. So the fact that I can suddenly increase my prices, the person supplying me the raw material starts to get wind of it. He starts thinking, oh, something's going on here. And I come to him more often. He has to go to his own suppliers and he's going to spend more time. So he starts to increase his costs. So truthfully, when we see prices go up or revenue increase, we suspect that the cost of sales should go up as well. Or maybe you'll found a different supplier, and that's great. We just want to test for it. So generally, if revenue goes up and cost of sales goes up, gross profit margin stays the same. You see, the only reason gross profit margin goes up is because revenue has gone up, right? Or cost of sales is the same, or the reverse. So we're suspicious if we see gross profit margins increase. We suspect revenue is overstated or cost of sales are understated, if you like. And that's where we're going. And there are other reasons from an evidence point of view why revenue could be overstated or understated that we'll come to. But I just want you to pick up the idea of suspicion. Right. So when I come in and I look at my current bank, is rarely ever, because we're going to do a bank reconciliation, right? So I'm sure you and I know, which is why I think it's Hannah who says she's in accounts prep right now, and I know Dudley's in industry, but the first thing we do when we do any audit is to reconcile the bank. So you and I know that 48 we see might not be actually what's in the bank. That's the cash book. So that 48, I mean, well, with today's technology, Xero and all these new software, it probably is, but let's just say that's 48. We have unpresented checks, outstanding lodgements. We have to do that. And just by doing that rec in itself, you are testing or confirming that that figure is what it is. You know, it's rare for that to be overstated or understated. A bank rec solves that problem straight away. And Equity and retained earnings are typically the same, and it's rare for you to have any understatement or overstatement per se there. The question of, so look at these now, loans. So long-term liabilities, loans. Here we have the potential for understatement. Now, you might think people are all honest, but it's possible that a business can take out a loan. You might think of it like this. Someone could take out, a director could take out a loan personally, or even in the name of the business, in the name of the company, and not declare it. And so they'll take out the loan statements will come through, the money will go into the bank, but you'll see money in the bank, but they won't have declared the loan itself. So debit bank and credit the loan. You should be able to pick that up, to be fair, because you're wondering what's going with double entry, but people are very clever. Sometimes you're never sure how they manipulate this. Maybe they have secretly credited retained earnings through something else. The question is, it has to be a credit somewhere, and it's just picking it up. So someone might have, or, I mean, I know you're thinking it's not possible, but they could put it within an expense code and reduce an expense. Really sneaky. So the question is that you have to be suspicious that there's potential understatement for all the liabilities, if you like. And I mean, it's clearer with the things like trade payables and accruals, because if you think about it, if I simply don't put the accrual through, well, you'll never know. Yeah, and so that's the kind of thing, that's the way I want you to think about. And if you go over to the next page 120, revenue, cost of sales, this is where we do a lot of real kind of, when we look at evidence, and we'll see some of that today, hopefully, where the potential is. If I want to make the question here is, why would I want to do this? Well, you and I know, I'm sure you know that, especially those in practice, that banks will give you a loan for 5 years, or will say something like, well, that's the first thing. And they'll give you, imagine a bank gives you a loan for 5 years. And the truth is, they will only renew the covenant based on certain performances, or you have potential buyers. And I'm talking about even normal, just day-to-day investors. They want to see certain ratios, or you want to show certain ratios. You want ratios to look good. You want gross profit margin to look a certain way. So you know that return on capital employed is made up of productivity and profitability. So chances are that if you're going to manipulate to get a good return on capital employed, you want to manipulate those balances. So we are likely to see people overstate revenue, understate cost of sales, understate operating expenses. I think Natalie mentions that. That's the big one. Think about it. It's big in construction, and typically, if you don't know what's going on with that, it's likely that you have normal things that should be expenses. They'll capitalize them. They'll put them, if you go back to page 119, they'll put them on the non-current assets. So you still have a debit. So they'll debit non-current assets instead of debit expenses. So in fact, they've inflated their assets as opposed to even increasing their expenses. So you're constantly ending every single sentence, yes, by this question of understatement and overstatement. So let me quickly, literally, just so that when you go back to, because I would like you in your own time to spend some time on, and the other thing I just want to say in general is that whenever you have an audit for the first time, because this is how it could turn up like this, where you have to do some number work, or you just get the scenario like TYU1. So whenever you have a first audit, there's a risk there anyway. Right, that this is a number one, but I'm not even going to I'm just going to run through it. Here we had revenue increasing by 12%. So as soon as I see revenue increasing by 12%, I'm thinking straight away, revenue overstatement. I'm not saying that, I'm just going to test to make sure revenue has not been overstated. We can come back to the discussion of the tests, but the key point is, I suspect that revenue is too much for that period, if you like. So the key point here is professional skepticism. And typically the other assumption that these are assumptions, that your first year of trade is typically a difficult year. You're trying to break into a market, there are existing people, competition, you're trying to break in there. So to suddenly be doing so well, I mean, if you are, that's great. Then we'll see the evidence, we're happy. But and in this case, I think they started selling to consumers via the new website. So, and again, remember, I mean, I almost can't help myself here. The question of revenue, when we say, from accounting, you remember that you had revenue less sales returns, right? To have net sales. The question here is, what if I just avoid putting in through those returns? What if I delay them? The returns have come through and I just delay the actual putting through the invoices. You can see here that I need to carry out tests to make sure that I've included sales returns for that period and that sort of thing. So maybe that's why revenue has increased. So generally, if revenue's gone up, well, by default, gross profit margin typically would go up. This has gone up by 2%. So, so yeah, I mean, overall, if revenue has gone up by 12%, it means cost of sales has also gone up. So I'm still, in my mind, I'm thinking that there's a potential here that either one of the two, either rev has gone up or cost of sales has gone down. In terms of understated, sorry, revenue is overstated, cost of sales is understated. I'm not, by the way, this is not financial accounting where I'm saying, oh, there's been an improvement of, or I'm trying to explain, or I'm writing a report. No, I'm just looking for understatement and overstatement. Okay, very quickly, and let me go on to the same thing for, Then for net profit margin, as soon as you see this type of thing for net profit margin, I think you pick it up here, indicating, so we have here a fall in net profit margin, an increase in net profit margin. So if you have an increase in net profit margin, so you have gross profit there, say I'm going to call that gross profit 100, and then of course I have overheads, and then I have net profit. So I mean, of course, if this was 50 this year, and this is 10, and this is of course I suddenly have this fall. So it's likely there is an understatement, most likely linked to the fact that I'm trying to capitalize some of these overheads as opposed to actually put them through, right? Because this doesn't make me look so good. So the key point here is you're running straight to the question of, I suspect an understatement in operating expenses, right? And that's where you're going. Inventory, again, you do your inventory days. Again, you're hitting that statement straight away. The key point here is I can see an increase in inventory days. You see, an increase in inventory days tells me that there's too much inventory, or inventory is not moving as fast as it should. What's the risk straight away? Inventory is probably obsolete and therefore is currently being recognized at values higher than they really should be, right? Because fundamentally, in IAS 2, you remember it from your earlier studies, we must always recognize inventory at the lower of cost and net realizable value. Net realizable value is what I can actually sell it for. And the longer you hold inventory, chances are. And then we can talk later on about the test. I'm sure you can already start to see, get an idea of how would I test this? Well, I'll literally whip out 10 invoices that when we bought the inventory, goods, when the goods arrived, get the actual purchase invoices, if you like, towards the end of the year, and get the sales invoices of exactly the same items, and see whether or not the cost was still lower than the sale of that same item at the end of the year. And if they are lower, if I've sold it for more, then yeah, then I'm happy with the valuation, right? But we'll talk about inventory later on. But it's that's the type of testing that we're talking about. And what makes me move towards inventory, or when I'm planning that we're going to go on, that I'm going to focus on inventory when I see this type of thing. You see, because I want to make sure that that figure, because when we talk about planning, we're going to talk about sharing resources and spending time, if you like. I want to make sure that I'm spending time on inventory if I see this type of thing, if you like. Okay, right. Trade receivables, exactly the same thing. We see here, you know it already. Whatever I see in inventory, when I see, because when I started studying accounting, I used to honestly think that when I saw trade receivables like 10 million, I really thought that was trade receivables. I just thought, yeah, that's trade receivables. That's what you're owed at the end of the year. So that's the figure that should be there. No, doesn't even mean that. It just literally means that that's what you're owed at the end of the year. The question is, will you, prudence tells us to ask the question, will you actually be getting this figure? You know, you're saying that what you're declaring, what you're asserting is that I will receive 10 million. That's what you're saying, but you might not. And so how will I test that? Well, I probably will arrive in the month of January, if this is December, and February. So I'll look at post-date receipts. And if you've only received 9 million, and if I notice this pattern every single year, then I'm thinking you need to put through a provision of 10%. So you're probably all going to lose. So I really should put through a provision of 1 million based on previous experience. So I should be really recognizing 9 million. So this is what trade receivable really means, that you're probably going to receive 9 million. So you can see the potential for overstatement. So the fact here is what pushes me to think like this ratio, 19, 30, gone up to 33 days. I'm worried. inventory and trade receivables is probably overstated. There's probably some bad debts in there they're not going to get, even though they haven't declared. And they might be keeping some that some of them might have been in there for a long time, maybe over 6 months. And so the etiquette. There's no rule. I don't even think there's a standard. I just think that, well, you as a client, if you're from your financial accountant, you can write off and claim VAT back. We did it in tax, I think, when we did tax for VAT. You can write off, you can only claim VAT on a debt that you've had for more than 6 months. So 6 months is the general kind of agreement, if you like, for this. Okay, trade payables. Typically when you have this kind of thing, so this is very good as well. You picked this up. So the fact is that if you have trade payables less, it says that you have an increase in trade payables. And so what we had here, I mean, this is a denominator. So if you have an increase in trade payables, the fact that this is this is a good one, because it's it's not sneaky, but it's really important. The fact that you have an understatement of cost of sales. And you see, the key point here about cost of sales, as you all know, is that the fact that you have an overstatement of inventory, remember you have opening inventory plus purchases minus closing inventory. So if you have an overstatement of closing inventory, because you're recognizing inventory if it's too high, you will have an understatement of cost of sales. That's the first thing. So this is where the understatement of cost of sales can come from. It can come from closing inventory. It can also come from purchases, but we can talk about that later on. So we can see ways that cost of sales could be understated. Right? These are how, and in other words, less than it really is. So if you have it less than it really is, this falls, and therefore you now have this going up. Trade payables. So it gives a certain impression that, okay, it's taking longer, but this is not a big longer, 25 to 27 days. So we could be content with that. But if truly a client was taking too long to pay its suppliers, you will start to get concerned about cash flow. You'd be like, are they having problems? So there is the risk of, as well, going concern. Can they pay their suppliers, if you like? And that's kind of the issue to think about there. And then there's current ratio, which I can let you guys carry on. And you know what? Let me just finish. I'll do current ratio as well. So now the key point here is these ratios are key investor ratios. As soon as you write this, again, like I say, audit is a language, is a technical subject. And as you study it and write it, you start to just know straight away, I see that, I'm going to say that. Current ratios, gearing, all these ratios, investors are interested in them. Return on capital employed. So I will do anything to manipulate my financial statement so my current ratios look good. No one has ever, it's not possible. It's never been done. No one's ever gone into a bank with a cash flow statement that has negative figures on it. In the end, you won't get the loan. Everybody knows you're lying, per se, with the inflation. Just look at Dragon's Den. I think we're going to sell 10 times, 10 extra 10 times than we really are, because we have projections. So everyone projects positively every time, because you want your figures to look good. So I'm suspicious already when I see healthy current ratios. I'll just have to investigate them, and I know where current ratios are made up of. So I'm suspicious, and I think there's a risk that there is a manipulation for many reasons. Maybe to keep the loans in place, to gain a new loan, if you like, to not lose shareholders. Same thing for gearing, right? Gearing, and again, yes, gearing can also give us an indication of liquidity issues within the organization. So here it's gone from 26% to 35%. So they've borrowed some more money. Again, I think what Natalie does here is to look at you look here. So you argue this is a acceptable level, and that's fair enough. But the key point here is that it's still, so you want to highlight the fact that it's still potentially subject to manipulation. So we're just looking at the figures. Our work is just to highlight the risk of overstatement or understatement or potential manipulation. That's where we're going, if you like, with these figures. Okay, right, great stuff. Yeah, so I just thought I'd show you that for the first 30 minutes, so that when you go back and you're building your notes, there's no rush, really. Just spend some time building your notes from chapter 1 to chapter 1 to 5, and yes, sir. Let me just go back. Yes, here we are. Go from chapter 1. Oh, no. You know what? Right now, okay. So I can't believe I forgot. Let me just send these slides to you right now as well. Apologies. I thought I sent them. So if you're having your laptops with you, you will be able to access the slides as well. Sorry. Let me just I thought I sent them this morning. Let me just do that here right now. Send those to you. Bear with me. Insert. Browse this computer. Planning. Cool, great stuff. So I've sent you my slides for today. Sorry, I I thought I'd done that earlier on, so I'll just go to them now. So I'll start speaking, but feel free to please yeah. So you can download the slides once they come through your email and carry and catch up with me if you're making notes on the slides. Great. So we're on to planning. So here we are. Now, up to now, we've been kind of looking at the concepts that we need really to accept the audit. I think it's important to highlight that. I mean, when we talk about planning, I think it's critical, because the thing with audit as well is, because this is the subject, we've been talking from the point of view of approaching a new audit, but also we also have to think about what's happening with a recurring or an ongoing client, by the way. That's the other thing. So that's the framework you want to keep. It's possible that you have new audits, complete new audits. So there's planning, of course, and there's, of course, the fact that you have an ongoing audit. But like all things in life, and hopefully when we look through that, I mean, please don't be scared. There's 145 slides. I probably won't get through all of them today. But this is the thing with audit. All of this information is just there, and we'll just take our time. But it's just what it is. Try and make it as real and practical as possible. So let's begin. So far we have talked about acceptance. So that was very much about the ethics of, should we accept this audit? If you like, someone comes to you and says, listen, we've heard about you, we would like to tender this to you. So you have to think about you have to make a decision. Should I accept the audit? And there might be I've written here, you need to consider sort of this question of ethics. Is there a self-review issue? Is there a familiarity issue? Is there a fee issue? And remember, that was to do with the fact that they might be giving you much more than your total revenue. You might already be doing some work for them. You might already be doing some work for the client, so you might know the financial director. These are all these sort of factors to, is there an intimidation potential issue? So that's that chapter. So that's the context that we come into this new chapter with. Now, we also come into this, we also studied audit risk, but we just looked at the concept of risk. We didn't really apply risk. We just talked about the different risks that lead up or define what's really considered to be the audit risk. You see, because you want to accept a new audit, but you have to think, is there a risk that I will give the wrong audit opinion? You see, that's really the real issue here, you know. And I guess like a lot of things, it's like everything, you know. Someone could come to you and give you a job, and you might think maybe this job is just too big for me. Maybe it's too risky. And why were those again? Remember that audit risk, the risk that you would give a wrong opinion, was to do with the inherent nature of the job and the control risk. And if you like, the detection risk, but I'll come to this one last again. So here's the issue. You may just not understand the industry. A lot of money for the audit fee, but you might, I don't really understand the industry here. Or like we said, you might have a really a dominant CEO, or these are just, I think maybe it's a cash business, you know, lots of cash here. And I think I gave the examples about the cash machines that I did some work on, if you like. And but there's this many, you know, I mean, again, this is the thing. I mean, I find it interesting. So I could end up giving you too many examples. I'll give you just this little one. Did I talk about I mentioned the Curry Mile, the restaurants on the Curry Mile in Manchester. In Manchester, there's a lovely, it's a place called Rusholme. If you're ever visiting, has anyone here been to Manchester? Anyone?
Yeah.
Hello?
Yeah.
Oh, cool. Sorry. Oh, great. Sorry. I almost thought I lost you all there for a second because you was totally dead. Quite. I was thinking, oh, and you've lost them. Oh, my goodness. Yes, if you go to Manchester, James, were you in the city centre, or did you actually visit Manchester, like parts of Manchester?
No, in the city centre.
Yeah, that happens a lot. It's a bit like going to Brick Lane in London, but you have a Rusholme, and they have the Curry Mile. And if you go to the Curry Mile, it's very much like going to Brick Lane. So you have all these guys standing outside their restaurants, kind of willing you to come in. There are lots of lights. It's really exciting. And for a long time, they typically were just cash laundries, so to speak. And just because we did some work, and it was the back end of it that I noticed with the event. You know how you have a chance meeting where you do an audit on a property business, and then you do this audit on a property business, and then you're trying to understand where the money came in from the property. It was a loan, basically, and we couldn't ascertain who the lenders were. So it wasn't your traditional lenders, if that makes any sense, for this property business. You know, typically when I want to see someone who I'm asking for the loan document, I'm expecting to see Barclays or Nationwide or something like that. And I just couldn't, it was a strange lender. And finally, I happened to be eating in one of these restaurants one night, and I saw the director of this business in another room, and he comes in and he's like, "Oh, Ian, how are you?" And I'm like, "Yeah." He's like, "Oh, how did the property audit go?" And I was like, he's like, "Oh, don't worry, you'll be all right. We were the ones who actually lent the money." Ha 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 ha. And I'm thinking, you shouldn't be telling me that. Because I was thinking, this is such a conflict of interest, because now I know this, but my partners knew anyway. So the point is that you get a lot of people won't touch restaurants, they won't touch washing laundrettes, they won't touch, because there's a risk, inherent risk of cash. So key point here is I need to think about my reputation. We need to think about our reputation as auditors. Do we accept this? So the reason why we studied audit risk first was to understand the type of risks we need to think about before accepting an engagement to a certain extent, and sort of think, okay, we can manage that. We have the personnel. So here's the other issue here. We have the personnel who can actually do it. There's no point if you're a small firm and then you go along and take this big audit for this big oil and gas work. You can't do it. So there's a risk that you don't even have the capacity to actually to do it. And then of course, there's the fact that the organization itself might not have very good controls. This is kind of where we focus on a bit more with planning. So it's kind of this, I will speak with the director and say to the director, what systems do you have in place for managing or for looking at your revenue? What controls do you have in place from when an order comes through to when you pay? And if he says, well, it's the same person who looks at everything, we don't have very good controls when the stock comes in and goes out, then I'm going to say to him, listen, I'm going to have to charge you more because you don't have very good controls. So this initial understanding of the business will enable me to decide whether or not I can even manage this. Am I willing to? Because with fewer controls, I'm likely to have to do more substantive work, and there's a greater risk I'll miss out on something because I can't test everything. So that's why we studied those chapters for context as we get to planning, where I now say, okay, you know what, I'm going to take this job. So I'm going to take this job, and we now have what's referred to as an engagement letter that's issued. I don't know if we did engagement letters, but it doesn't matter. We will see it anyway, where we issue a contract of engagement where we now discuss the terms. We probably did the term, but we'll come back to it again, because we get nice 4-marker questions on these engagement letters, and they ask you to name 6 things in an engagement letter or 5 things in an engagement letter. So the scope, what it is we're going to be testing, what financial documents we're going to be looking at, what financial standards, what standards we're going to be using, so international financial reporting standards, our fees, the length of time, the responsibility of management, how long the engagement will be for, that sort of thing. We now agree that, and so that's great. I can now go ahead and start planning the audit. As you can imagine, I won't turn up, if you like. So now this is the thing. I won't. So I borrowed this slide. I thought this was a really great. I mean, I used to always talk about this, but then I saw this slide on Open Tuition, and I really liked it. So it is borrowed from them, but I like the slide. The key point here is that you wouldn't turn up to start an audit suddenly if the year end is 31st December. You know, you're not just going to turn up a month after and start the audit. No, you must have, and this isn't just about a new audit. This is about all audits, if you like. You will turn up at least, or you will start having discussions at least 5 months, maybe 4 months, but you start having discussions. Remember now, we've accepted the audit. We accept that we can manage the inherent risks. We accept, as I will discuss in a second, there might be control risks to certain levels, and you've agreed with our fee, or we might have a recurring audit, and I already understand the controls in place. So you can see the spectrum of the thinking. I hope you're starting to see that. So this idea of so now we need to plan the audit. Now, again, the reason why we need to spend time understanding the entity, again, this is to certain degrees here. If I have been doing the audit over and over again, I have a good understanding of the entity. I know what areas of that statement, the financial statement, I want to look at, right? I need to know what are the risk areas, or what are the balances, what are the areas I'm interested in, or that I want to spend some more time on. We're going to see all that as we go along. Things might have changed. Hopefully we'll see that as we go through the slides. You know, last year you might have been a company with 2 subsidiaries. This year you might have gained another subsidiary. I need to understand all these changes that have happened. Last year you might have had 10 contracts. This year you've lost 5. Last year you weren't in the year of paying your final liability or your loan. This year you are. So changes are constantly happening, and I need to be aware of them in my planning. You see, I can't assume everything happened as it was last year. So I need to assess, if you like, the risk of material misstatement. So maybe last year you were selling certain products, maybe this year you're selling some other additional products, or maybe last year you had a completely different IT system, and this year you have a new IT system. So there is a risk that there will be errors. So that's what I'm thinking about there. So I need to respond to this risk. And so typically, like I said, of what I said here. So sorry, forgive me. Again, I think Natalie will understand where I'm coming from. If any little people burst in, I will drive them away. But just if you hear, but you know, I'll just in case, because they don't know I'm in here. So I'll just have to kick them out. Please excuse the drama. Okay, great. So typically we expect to have effective. I mean, so there's 2 things here. In my initial, well, again, it's about. The reality of it is that let's pretend this is my first audit. Perfect. So you've given me some indication of your level of control, and I've said, okay, you know what, it's okay, we can manage that. So I'll come in and I'll actually test the controls myself. So I'll actually prepare a document, and we will see that as we go, as we carry on. I'll actually prepare a document documenting the actual internal controls in the organization. Now, the key issue here is many organizations might have an internal audit department, which will already, I mean, I'm usually not in today's world. Most businesses actually have very good documents on the control systems for different departments. So typically what I might end up doing is I'll walk through the term that you must use all the time. I'll literally walk through the controls myself from beginning to end, and just to see for myself if it picked up any errors. I might put in a false invoice to see if it was authorized or if it went through, put in an extra 0. If you like. So I will test these controls on those different systems within the organization. I've said many times, we're talking about sales, we're talking about purchases, we're talking about inventory, we're talking about non-current assets, we're talking about cash, we're talking about wages. Those are our typical systems that we expect to see controls over. And when I say controls, not IT, just authorization, clear authorization, clear authority between the next one move and the next, from procurement, ordering, to approval, to it being sent out, to us receiving the invoice, to the invoice being put on, to us getting the money, to it being filed, if you like, and getting the money in time, that sort of thing. Right, so if the controls aren't happy, if I'm not happy with the controls, again, you can see this is just a big spreadsheet, it could be a balance, then I will literally tell you that, well, in that first year, I will carry out substantive testing, and at the end of my audit, I will put together what's referred to as a management letter, where I will record all the weaknesses, and we'll come to this as well. In fact, today we will see this. I'll show you a sample of one, weaknesses of all the controls that I've seen, so that you kind of make sure you get these in order. So the next time I come, so very much in terms of my even understanding my entity, something I always did was I would go back to the management letter that I wrote for the previous year and send that to the client and ask, have you done all these? Have you sorted this out? You know, so that I don't come again and I'm going through the same problems and you're telling me, yes, you have. So then I'm like, okay, great. You know, again, I remember, I think 2 weeks ago, I highlighted that I'm still able to carry out my work, even though they're weak controls. I'm just going to carry out more testing, if you like, and you see what I mean by that. And of course, when once I carried out all my testing on all those balances, then I can write my my final report. But this is the general planning procedure here. The starting of it is for me to understand if there's been any changes, and to understand if you have worked on my management letter from the last year, if it's a recurring audit, if it's a new audit. I want to look at controls to see how much work I will be doing. Cool. Great stuff. Okay, great. So some general material from I've tried to also line up with your textbook so that when you're reading, it lines up with that. So the general gist ultimately is that there's a standard on planning. These are expensive jobs. So we want to be able to carry this out, if you like, in an effective manner. So the whole idea about these standards is to make sure that we're all carrying out audits in the same way. I've highlighted the fact that they're complex, they're risky, and they are expensive. Right, yes. So again, yes, many businesses will have internal manuals and procedures, if you like, but the key point, like I said earlier on, is that I guess it's planning, right? Which is why I said we start 5 months before, and I'll show you a timeline in a second. I mean, like all things, when you're planning, you're trying to make sure you test. You want to, because you're certifying that all the balances on that statement of financial position are true and fair, aren't overstated, aren't understated, if you like, are what they are. So, actually, 1 second, let me close this window. Like, are what they are. And the only way I can do that is to make sure I plan so I have time. You see, you want to make sure you give enough time to the different areas. So by understanding the areas early enough, because probably you can only be there for a week to 2 weeks. 2 weeks was the maximum I ever spent, 2.5 max. but you want, whilst you're there, you don't, it's costly. You don't want to be out there annoying people in an organization. So it's really important that you want to be able to kind of devote time, resolve the problems on a timely basis. Again, I highlight this issue of changes. So I've already mentioned that all those changes that could have happened. I've given you a number of examples. New subsidiaries, financial directors have left, new contracts, old contracts, inventory changes, inventory, new venues, new places where inventory is being kept, new loans, if you like, new covenants. This question of questioning yourself ethically is that now imagine that the classic case is that maybe you charged a fee of $1 million from the client. I'm just picking up a number, and this made up, if you like, 5% of your income. And imagine now you're going to be doing some more work because the scope is larger, financial statements are broader, and you might end up charging them now maybe $3 million. And this is now taking up maybe 10 to 15% of your overall income as a firm. So you need to start thinking about the self-interest threat, if you like. Should you really, well, not that should you in the first year, okay, you should, but you need to get a second partner to carry out another review of the work, because this is why planning is important, is really, if you like, it's really important. I mean, I've seen it before, where you go in there. There's a guy, I mean, they're still married till today. There's a guy, I mean, you won't know him. His name is Dan. Just say Dan. And Gemma. It was so funny. We all studied together, and he was an auditor with us. We were all the same training together, and she was doing ACCA, and she was working in an organization. I don't remember what they did. And he became the auditor on the job, and she became the FD on the job. Now, as far as I'm concerned, that was a conflict of, I thought, this is wrong. Dan should be taken off the job, but Dan's like, no, I like the job. We're like, yeah, we know why. So Dan would often go to the job, and he would visit Gemma, and they're married today, and they live in Seven Oaks. So just in case you're passing by, sort of rattle it. Any Dan and Gemma in the area who live in Seven Oaks, if you're passing in Kent somewhere. So the key point here is, if there are new relationships that are developing, you need to be questioning yourselves, should we be taking Dan off the job? So that's why planning is really important, really, so that you don't get into trouble. Right. Okay, great. So I'll move pretty quickly. Again, I've highlighted this question of here, like we're trying to make sure we do this in an effective manner. I've already talked about this question of selecting team members of appropriate capabilities and competencies. Now, when we looked at this, let's just go to non-current assets, inventory, bank, cash, current liabilities, loan, overdraft, payables, and then long-term liabilities, loans, and then equity. So what you would have is, imagine I was the audit senior on the job, and I had Dudley, James, Hannah, and Natalie. So I might say, okay, maybe because Natalie, Hannah, and James have been in practice, and Dudley has just joined us. Maybe this is Dudley's first audit. I might just ask Dudley to work on, if you like, the bank, and just reconcile. Sorry, Dudley, to reconcile the bank account. I think this is the worst job in the world. You sit there. The truth is, right, things have changed. I don't even think people reconcile. I mean, James, Hannah, Natalie, do you guys actually reconcile, like get paper checks, paper statements and reconcile to cash books anymore?
Yes,
Yeah.
Unfortunately.
Oh no.
Yeah.
I thought QuickBooks had ended that. I thought that was the whole.
What we find, Doyne, is that a lot of the bank feeds in the software do not pick up all the transactions. So when we come to looking at the trial balance in the bank account, it doesn't reconcile with the physical bank statement. So we haven't, I mean, it doesn't happen all the time, but I think
sure.
the feeds don't pick up say a couple of transactions and
Right.
you've got a problem.
Right. Yes. Right. Well, then, there you go. So, sorry, Dudley. Yes, you will still have to reconcile old school style. Sit there with the bank statements. Sit there with the, if you like, the bank ledger or whatever, the cash book, and tick literally and find any. It's the same old classics: unpresented, unpaid, bank statement, charges, whatever. Absolutely anything, and reconcile that. And typically, you might give 2 days, if you like, to the audit junior to sit there and do it. In fact, typically, yeah, he might do it for a couple of days, depending on how big, of course, it is. Now, typically, so that's bank and cash, of course, together. So I might give, I'll say, look, James and Hannah, I might say, you know what, you guys, you can work on trade receivables. So the order of chaos really is cash and bank, so to speak, and sometimes you can have more than one bank account. Of course, many companies have more than one bank account. And then I'll say, James and Hannah, you guys, you will look at trade receivables. Now, the key point here is with trade receivables, there are a number of tests when we come to look at it. We're trying to look for, typically, we want to know if those trade receivables will see this, if they actually exist, first of all, and we want to talk about valuation. So in terms of existence, you would pick some out, and from the office, what you'd have done is you'd have picked some out, send letters to them, and actually say that, oh, listen, these people say that you owe them this amount. Can you confirm yes or no? And they have to send you a letter back. And these are called debt circularizations, right? And I might just ask Natalie to actually go and speak to the directors to actually find out and inquire, about the loans, if you like, to actually see and literally look them in the eye and say that there are no other loan statements. First of all, you see, because with the loan statements, we can see the loan statements. I mean, if loan statements are slightly nice in a way, that because what you see when you see a loan statement, you see, say for example, someone takes 20,000, you see 20,000, and you see them paying, you see interest, and then you see capital payment, interest, capital payment, interest, capital payment. So we can reconcile. So Natalie might spend her day reconciling the finance costs to the income statement, and the capital payments, of course, to the loan, in the loan code, and the balance must reconcile, whatever the balance is at the end of the 12 months, must reconcile with what's on the statement of financial position, when we sign off. So that shouldn't in itself be the issue so much. The issue is very much more about, are these all the loan statements? Now, typically, the audit senior or someone more senior spends some time looking at inventory, if you like, because that can also be quite an interesting one, because there's a lot going on there. All of us would have turned up to the stock count on the 31st of December. We have to be there, if you like, because again, we'll talk about that, because really we must be there for control. So that's part of when we look at inventory, we want to make sure we're there, because we're not there in that business every single day. So we want to make sure they have good controls in place. So the only reason, by the way, I'm sure you know already, for those of you in practice, the only reason we turn up to stock counts is control issues, not valuation, partial valuation, but control, right? And to make sure that they have good control. So so we want to observe the stock count ourselves. So if we can observe the stock counts, we say, oh, you have good controls over your stock count, so we can now sample some of the stock lines for valuation. Otherwise, we'll have to literally count all the stock, and that's very difficult. So we want to observe that. Okay, great. So you can see here this question, you don't want to give someone who's new an area that's difficult for them. So that's why planning is all very much this work has to be supervised. So you must also give time to be able to review the work in time. Whoever's now, of course, now the other issue, again, like I said, the purpose of planning is, so imagine I say that, okay, listen, we're going to come in the last week of January, but then you have some specialized, think of jewelry, for example, or even chemicals, or even sometimes non-current assets. If you need the help of an expert or internal audit, you also need to make sure that they'll be there in that time to help you. So there's no point booking to go out to do an audit if you don't have that time. I mean, I'll come back in a second to talk about some doing audits, doing some work before the actual year end, interim audits, and you can do some work. So you can see this is why planning is so important. I'll come when I come to my timeline in a second. So if I need any experts, so surveyors for property, if I need valuers for some of the inventory, maybe I don't understand it, there's no crime in that. We are allowed to use the work of experts. I need to also be able to get time to do that. If the controls are good, say for example, a company has 10, say 12 sites, and even for inventory, if the controls are good and I can trust internal audit, if I pick up 6 sites randomly and we do them, I can get the internal audit to do the other 6 sites, but it has to be done. We all have to do it together. So it's really important to have planning to coordinate it like that. And so the reason I'm talking about it like this is so that you can start to kind of put yourself, because any answer, you could almost give any answer in audit per se, because there's so many answers, but you just have to you're just thinking from an efficiency point of view that, right, we want things to be effective and efficient, and we want to be thorough, so what would I do? What steps would I take in general to be thorough? That's all we're doing. So we don't want to give, like you see here, we don't want to give a poor quality audit, which could end up leading, if you like, to giving an inappropriate audit opinion. That's kind of the issue here. So we're trying to kind of, again, bring down that, again, like I said here, the risk of the risk, the audit risk that we would give the wrong or an inappropriate opinion, if you like. So this is what I was sort of highlighting here earlier on. Imagine this was year end, 31st of December, and I would go in there and start my planning here, say in September, start planning the audit, because I now have understood changes that have happened over the year, and I will integrate those changes into my planning, if you like. And remember, not just that, people might have left us as a firm. So I need to think, do I have the right audit senior for this job? I'm going to have to promote Dudley from what he did last year to doing other balances. Okay, maybe Natalie will manage Dudley here, and then, okay, James will look after Natalie there, or Natalie will side with James will work with Natalie on that. So there's a lot going on, why planning is really important from both sides, our side as a firm, and also looking at the then there's some things that don't change. So for example, if they have a factory, if you like, and they have some non-current assets, right now, typically if nothing has changed there, I could say, okay, you know what, Dudley, if you drive down in October or November and you actually just look to see if those things still exist, and just observe, and then carry out some valuation work in the office, so that when we come back, we're not doing very much work on PPE, on property, plant and equipment, maybe, because the truth is, if it hasn't changed here, it's likely it's going to change here. So you see, it's these kind of property, plant and equipment are very different to the other assets in the organization. So we can start doing some work earlier on these. Okay, great stuff. Oh, sorry, let me just check so that I don't burn you out. Oh, 10:30. We started at 9:30. Oh, we can carry on. Okay, I'll push you for another 15 minutes. So the planning process. Planning consists of a number of elements. However, what we will do, again, just to summarize. I mean, you're not really going to remember it like this, but again, like I said here, performing procedures regarding the continuation of the client engagement. So what we agreed last year, is it still the same this year? It might not be. There might be more work, and we don't want to be doing work for money that if we need to do, if the scope has increased, again, like I said, have things changed from one year to the next. Have things changed from one year to the next. I've evaluated our ethical requirements. Right, Dan is now married to Gemma, so Dan can no longer be the key auditor or the audit senior or the audit manager. In fact, the audit partner on that job. No, he cannot be. He has to let it go to someone else. Yeah, I mean, it's interesting. You might think this doesn't matter, but people move. So you might have a new director, FD, who doesn't really quite understand his responsibilities and isn't as forthcoming as the previous one. So it's just going through the engagement letter again. So please go to page 235 of your textbooks. This is what I was saying as well. I was highlighting the fact here that where are we here? Page 235. What I was saying is part of planning. So whenever you do, we'll come to it, but we have exam questions, maybe not big ones, maybe part of a question where you might be asked to actually draft a management letter. It's almost like looking at controls ultimately. So page 235, well, into page 236. So if you start at the bottom of, actually the bottom of page 235, it says that you may be required to prepare extracts for inclusion in a report to management. So typically what would happen is as all of you are doing your audit work, I would ask all of you to note down any control issues that you met, or any authorization issues as you were going along. And what we do is we collate them at the end of the audit and put all of them, if you like, on a document. So on page 236, you can see here, there's a management letter extract. It's got deficiency, consequence, and recommendation. Yeah, so that's kind of the issue here. You can see the top of the page tells you clearly what the deficiency is, the consequence, and recommendation. So we also kind of inquire, this is on a recurring audit, that what have you guys done about these issues? Have you corrected them? So a classic one might be segregation of duties. You might have the same person who opens the mail, and is the same person who opens the mail, who puts it into the, if you like, into the system, and who then pays or something like that. So the question, there's a matter of control there. So a recommendation would be like, okay, have two people open the mail together in the same room, and then when one person does it, have someone else check that all the checks that have arrived via the post room. Sorry, that's another one I want to ask. Sorry, forgive me. Does anyone, I mean, in a way, I keep thinking that it's just that I keep thinking that it'd be great to go in, and I am thinking about it, or maybe going back into industry just for a while. It's just the stress of travel. Do you guys still have post rooms?
No.
No.
I don't know, you might have come. See, there's always used to be like this little room that, because people don't do checks anymore. And in the morning, every morning, two people would have to go into this room, right? And bags would arrive, and you'd all pull them out, and you'd all do the checks, and you'd write everything down, and two people would have to watch to make sure no one pocketed any checks. Because you might be thinking, but Owen, how would they? And I still know you can do it today, because it's happened to me before, where someone could take a check written to you, crossed, ironically, you'd be surprised, and go into, these cash generator type businesses or cash converters and still cash a check. So it's still very possible to steal checks. So it was important to have someone always look at the other person for control purposes. But we could have control issues in other areas. I mean, again, like I say, we could go on. Sometimes having controls over the standing data in organizations is an issue as well. Sometimes think about it like, okay, sales. So an order comes through. Some people have authority to be able to give a discount, if you like, but typically that data about how much discount you can give should be standing data. So it should be fixed within the system. You shouldn't have people who are just able to change that data at will. And sometimes you want to test that. Can that be changed? If you like, is there an authority to change it? And even sometimes control. I mean, the worst kind of control, if you like, it is, as you would expect, if I wanted, and I have seen it before. Let's go to Dudley, yes, because Dudley is in industry. Dudley, say for example, you wanted a stapler. How would you go about ordering one in your business? If you wanted a stapler in particular, say you wanted something for yourself, you thought, oh, I need this thing. Could you just
ask the individual who's has the authorization to the Amazon account and just ask them to buy me one?
To buy you one.
Yeah,
right.
There's things now been put in place that possibly inquired by IRS that we can and can't do, and there's so many chains. Command has got to go up before it gets authorized.
Excellent, excellent, exactly. So you can see they have controls in place, but I've been in places where up to they have limits. So they'll say something like up to 250, you can order it yourself, you know, or up to £100, you can order it yourself, such that you don't need your own manager to authorize it. So you can literally go to that person and just say, order me this thing, and he just orders it for you. You know, so that's these are the types of things I'm talking about. This question of having putting things, you would observe these type of controls in the organization, but it depends. It's because there's so many systems, right? I've talked about 6 systems, if you like, and so it's just about which system are we dealing with. Okay. So that was that inquiry to what extent these recommendations have been implemented, right? And so, and the next bit, therefore, so once we've done that, once we've dealt with kind of the past, and we've got the setting right, we've dealt with the ethics, we now feel, okay, we can ethically continue with you. We now feel that, okay, we've looked at the history. Are there any changes, any new changes? We've implemented or integrated all the new changes to the organization, all the new people who have left, all the new systems. Okay, now I know about them. We now need to decide how we're going to actually carry out this audit. And so the 2 big issues here, if you like, are audit strategy and the audit plan. We need to write that out, if you like. So on page 138 of your textbooks as well, there's a very good kind of table that tries to kind of give you an understanding of what audit strategy really is, if you like. So I mean, that's just a good overview, but I mean, audit strategy, even the word strategy hopefully should take you into the idea or the world of big picture, right? So typically the audit manager would set the strategy. So when I say the audit manager, think of it like this: you have audit manager, audit senior, audit juniors. So right up here, audit manager sets the big kind of scope of the audit, because you see, all of you would be just like you are. All of you would be out doing exams and training and doing different jobs. So all audit managers are talking to themselves and thinking, okay, who is free, you know, and doing all the timetabling and that sort of thing. So the audit manager is doing budgeting. You can see budgeting, you know, time management, that sort of thing, speaking to the FDs. So kind of the high level, highbrow kind of design of the audit. So just let's go through a couple of those things. Like I say here, the resources to deploy for specific audit areas. So the audit manager will also be liaising with the external experts. When can you come in, if you like, and making sure, you know. So even within audit, so we have audit juniors, and we have different levels of audit juniors. You can have year 1. Typically, the whole year is your audit junior year 1. And a half audit senior year 2. So you guys would now technically, as you're moving into your finishing the second half of your subjects now, second year audit senior, final year definitely audit senior. So so the audit manager, you know, he's getting the experts together, he's contacted them, he's applied for so typically, like I said, the bank letter, we would apply directly to the bank, and the bank would send us the bank statement directly to the firm. So he would make sure that's all right. Well, he might actually ask someone to do it, but the key point here is that he would be in charge of that. Number of teams, he would need to know, okay, how many people are going to go here, where are we deploying these resources, who will supervise the meetings, debrief, review. Again, based on past experience, looking at the last year's file, very popular. You're always looking at last year's file to see how long they took on a particular audit. Yeah, I mean, this technically, so again, like I said, I've said several times, depending, we're thinking about recurring and new audits. So again, we're looking for risks. So I don't expect for a recurring audit that the financial reporting framework would have changed. We already have that. But if it's a new audit, we need to know what the financial reporting framework is. Am I using IFRS, or am I using UK, if you like, UK standards, UK FRS standards? Is it a listed company? Is it charities? And as you know, the standards are different, of course, and you need the right people who can actually work at that. Again, this issue of number of locations and branches and subsidiaries. So yes, I trained in Manchester, but typically when the folks in London, if they had a big audit in Manchester, we might join them. So they said, oh, Ian, you're working out with the team in London, but they're working on a client in Leeds or something. So go to Leeds and you'll see the audit manager there. And so the audit manager has to, because people have, sometimes you want to, especially the inventory for sure, you want to go along and try and get there. So you might actually have to join a stock take at a different branch or subsidiary, or you actually want to go and see if it exists, that sort of thing. Again, I've already highlighted this need for specialized knowledge. Yes, this doesn't change so much, but this question of the reporting currency. So it is possible that a company might have a, and I mean, I've been really gentle here. You might be even auditing, again, consolidated financial statements, right? So you have a parent company with subsidiaries that are trading in different currencies. Maybe this is very possible. Or you even have them buying goods from abroad. So you want to just be aware of what that is, and the stuff. Your people who are going out there actually know how to deal with those sort of currency issues, so they don't panic or anything. Effective IT and audit procedures. We'll talk about this later on. We will talk about how much IT we can actually use. So nowadays, there are these computer-aided assisted technology. So literally, just think of it like Excel. So think of it like, this is my computer. I mean, what am I saying? This is going to be happening more and more often, actually, which is why I'm at home, and literally, I will literally just use my software and come into your system and say, for example, I will literally just lift out all your ledgers, literally, and just transfer them into Excel and just do my work on it, literally. So I don't even have to come onto your premises. I probably only have to nowadays, to be fair, only turn up to see if things exist. But literally, I can now from here just log into your system, as long as you give me permission, and carry out my work looking at your systems, if you like. So the question here is, how much of that are we doing? I talked already about this idea of an interim audit, where I said, for example, I might say to Dudley, go in and just have a look at the non-current assets. Let's make sure we clear out non-current assets early on, so we get that done. So we need to have some timetable, and they have to allow him come and plan for meetings, if you like. So you can see here all very kind of obvious things here. And when we will all meet. Yeah, so communication with team members, expected communication with any third parties. Again, like I said here, what are the significant things I'm thinking about? Of course, when we did risk, we also did materiality, if you remember. So when I say, for example, I will say to, I think it was James and Natalie who were working on trade receivables, I will say to them, listen, our overall materiality is, our total materiality, for example, is 100,000. Total materiality. But, oh no, sorry, maybe say, whatever, 500,000. And I might just have assigned 100,000 materiality to trade receivables. And I will say, listen, what I'm going to give you, so it's good I'm talking about the terms now, is I'm going to give you guys a performance materiality of 50,000, which means that we will accept errors up to 50,000. Really, we'll accept a total of 100,000, but I want to keep it at 50,000, right? I've split this 500,000 that I have overall, but I'm just splitting it into different balances. So 50,000. So when you're looking for, if you're looking at trade receivables, for example, if you see a trade receivable and you see a bad debt, if you see a bad debt that year end is December, and you see a bad debt in March for 25,000. And you say to the guy, listen, you have this thing here for 25,000. I think you should take it out. He says, well, no, I've been speaking to the client. It's okay. You're like, fine. You carry on looking. You see another one for 10,000. You say, listen, this 10,000. Well, you're making a list of them, by the way. You say, oh, listen, I don't like it. I think you should take it out. No, 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 we've been speaking to them. Then imagine you now see another one for 35,000. So now you've seen 3 that have crossed over the 50,000 mark. So you're going to alert me. You say, oh, Ian, listen, there's 3 here that I don't think should be in there. They're causing, I think this is now overstated. Say their balance, say their trade receivable is currently showing 450,000. You say, oh, Ian, I think this is overstated. I need to reduce this 450 by 35, 10, and 25. So literally, it's for me to now say, okay, let's look at some more. And if I notice some more and I'm not happy, then we say to the client, listen, we're not happy. We think you should take these out. Or we get some correspondence from these guys. Basically, he has to prove to us that this money will come. And remember, this is December. So where we might be in February, this is a whole year. So if we find evidence or letters of assurance that this money will come, yes, okay. But if we can't, then it might lead us to want to qualify. When I say qualify, and say that we're not happy with the audit, and this is therefore these mistakes are this will lead to material misstatement. We can't quite trust this figure anymore of 450. So hopefully you're starting to see how this all kind of connects. So you can see why. So which is why we talked about the concept of materiality. This was all very important. I would set all this would be set at planning, so that when you go in to do the audit, you're not going in blindsided. You're actually going in there very aware of the boundaries to which you're willing to go and accept. You're going in with this professional skepticism. Yes, you're constantly thinking anything that's too high, I'm not happy with. And you have last year's audit file. So any issues with any particular clients, you will have to hand. Okay, great. So yeah, a couple of things here. Internal controls. The audit strategy would have those in place prior to you going in. I've talked about this already. The audit manager has been very aware of any significant business changes, any industry developments, any financial reporting changes. A lot really. Again, like we've said here, the budgets, people, the engagement team. Right. Yes, and that sort of thing. Cool, great. So that's kind of the audit strategy. So really 3 parts to planning. Well, when I say 3 parts, 3 big parts to planning. Everything that happens before we actually go in, a re-understanding of the organization, given any changes so far. We've accepted the audit now, by the way, remember. We have accepted it. An ethical review of what's going on. And then, okay, we've done that, right? And looking at the engagement letter again, listen, guys, we're going to be doing more. It's going to cost us more. It's going to be more time, blah, blah, blah. You've taken on a new subsidiary. Are you happy with that? Okay, we are. Are we happy with it as an organization? Do we have the staff to carry on? Are there any, in terms of our reputation, is something we should think about or whatever, just understanding that. Fees as well. These are the little things to think. Have we been paid for the last work? Were we paid on time? Is this still a good client to work with? And then we throw ourselves into the actual planning the audit, like everything you just saw me doing, making sure we have the budget right, making sure we have the teams right, and all of that. Cool, great stuff. Right, yes, let's take I should let you go to get a breather. Let's take a break and let's come back at, it's 10:52. So let's come back at 10 past. I mean, it's okay. Come back at 10 past 11. So get a glass of water. It's really warm outside. One thing, at least one, I mean, there are no benefits. I mean, when I say benefits, I mean, I don't know if you've noticed how much the sun is actually shining. It's like the sky is actually clear because there's just been no cars on the road for a month. Such a really bright sunshine out there, but cool. So I'll see you in about 10 past 11. Okay, right. Are you all back? Can you hear me?
Yeah.
Okay, great stuff. Cool. Right. Cool. Sorry, I'm just checking. I noticed that Hannah, Dudley, and Natalie, your mics are quiet. Wait, 1 second. Oops.
Hi, Owen.
Okay, great. I just wanted to make sure that you could, yeah, just to make sure you're not, I haven't lost you or anything. Where is it? Okay, great. So you're all there. Oh, I just saw the chat. Yes. Oh, James. Yes. Oh, James. Yes. Yes. I saw. Yes. Don't worry. Really, you weren't feeling well. I remember for that thing.
No, I had flu, so I'm not really.
Yeah.
I didn't revise for 2 weeks before, so I'm not.
Yes.
I'm not too disappointed, to be honest.
Yeah. No, you all. I mean, it was just all of it. I mean, Graham passed as well, and Abby passed as well. And you know, Abby did performance management as well. Do you remember?
Yes, and she passed, didn't
And
she?
she passed it as well.
I know, I was so chuffed for her. I was like, oh yes, at least we got through.
Well,
Yeah.
2 papers in one, that's not bad.
2 papers at once. I mean, I remember her saying, oh, you know, I haven't got time to study for this. I'm just going to go in and treat it like a mock. So yeah, you know, it gets done. So I wouldn't worry. You'll go in and you'll be fine. Cool, great stuff. Let's carry on. Where was I? Yes. So again, like I said, the first part with planning we've discussed. Then we talked about the audit strategy as a whole, and that audit strategy is just that big picture approach. In terms of just trying to make sure, very audit manager approach. And then we actually have the audit plan. So once the audit strategy has been established, really the next stage is to develop a specific detailed plan to address how the various matters identified in the overall strategy will be identified. The reason why this is important as well is because we might have had, typically we know we have problem areas, and by the way, remember that the audit isn't just, maybe I sometimes I forget, the audit isn't just about the statement of financial position and the statement of profit or loss. We also have the disclosures and all the notes that also have to be audited, and then we have all the sort of yes, when I say disclosures, really things that have to be checked. So typically your contingent liabilities that have to be mentioned. If there are things that we might be in court, we need to make sure we investigate and make sure, see what the probability is of that happening, so we can document that so that investors can see that. So it's really important to get a very clear, detailed plan in place. So I hope you can see my slides moving, by the way. So the audit plan is very much more detailed than the overall strategy. It's very clear, as literally really focusing now on each balance again. And planning, so yes, planning on these procedures typically will look at the actual risk assessment, or the actual procedures that actually are carried out. So what is it? It should, again, the audit plan should include the nature, the timing, and extent of these risk procedures. So the nature and timing, what audit procedures are to be carried out. So I've also sent you, if you notice in the email I sent you, I sent you a PDF document. So this is what we'll be really spending time on. These are the type of things we'll be talking about when we, oops, sorry, let me just charge my, this is the kinds of things we'll be talking about when we come to audit evidence. If you open up, I'll open it up now. If you, let me just get there. Yes, and let me share this. Right, so typically what you will see is a plan, if you like. So you will see a very clear plan for every balance, which is why sometimes in audit people just tell you to just follow the template, literally follow it, and there'll be, I mean, this is just kind of highlighting what it is, but you will get the procedures telling you exactly what you have to do. And I guess what you do get over time is you start to understand why you're doing it, and you can always ask. But typically, you'll have maybe another column here where you have to tick, for example, that you've done it or something, and at the back of these instructions, you would list out your results. So for example, I'm just going to walk through this one, for example. So here we're looking, so you can see here it says audit plan for receivables. So I think that was Hannah, I think, who was looking at that. So it says here, first of all, agree. So this is on the system. So typically they would have sent you you would have the actual account statement of financial position, and you will see trade receivables, say 1 million. And then you would go to you would literally print out this page, if you like, and you would literally in the section in the file for trade receivables, the next page, you would have the accounts with this thing here saying 1 million. And then behind this, you would literally go to the sales ledger, if you like, from the individual sales ledgers. So as you and I know, I mean, I know it's still accounting, but we have the sales ledger, which actually has the list, doesn't it, of all the individual trade receivables. And you will see that, and you get the full balance from there, and agree that balance to that sort of total of all those individual sales ledger accounts. And then what we also do here, I mean, there's a reason for doing this. I mean, you might, I'll pick it up in a second. And then what we also do is we match the total of that aged receivable listing to the sales ledger control account. So a number of things here. We're doing two things here. First of all, the reason we're looking at the individual, again, I am going into evidence, but the reason we're looking at the individual sales ledger control accounts is, as you know, sometimes the sales ledger accounts can have credit balances. Typically, we expect these to be debit balances. So it's not unusual that we would want to know why we have these credit balances, if you like. So maybe there are errors there, maybe they shouldn't be there. So it's really important to be able to see the individual sales ledger control accounts. Now, once you're happy with that, then what I'm able to do, because you see, really and truly, I'm sorry if a system somehow, the sales ledger control account literally should match, if you like, the individual sales ledger accounts. They should match. Most businesses just trying to carry on. No one's trying to defraud anyone. So what I now do is match that. So I literally just get a total of I'll get a breakdown literally of all the individual, just like on Sage, they will pull it off 30 days, 60 days, 90 days, get that breakdown and just match that to the sales ledger control account. So you can see here that I'm just trying to make sure all the figures agree, and then I start carrying out. Then you see here it says trace a sample of shipping documents to sales invoices. So this question here of a sample, as part of my audit plan, the audit senior would have said something like pick 10, if you like, invoices and find their shipping documents, if you like, and trace them. So you literally will find 10 documents, maybe one in each month. You're just really looking to see they actually occurred, if you like, and they're all, if you like, they've happened all throughout the year. But we'll come back to that. But you can see here that the plan is this detailed. I'm not going to leave it to the audit junior to guess and pick for himself and say you pick. No, he's gonna. I want to know if everything, if all the sales for the year, if you like, have been put there. So plans are as detailed as telling us how much or what sample, if you like, should be there. And then again, you can see here, we now compare gross profit and literally. So the key point here is that, but just kind of dipping into audit evidence, you can see that I'm expecting receivables. When I see a question of 1 million, I'm expecting that this issue of completeness means that, and I expect, because it's an asset, I expect all of them to be there. So are all receivables in here, if you like, and then you can see there's a test for existence as well. Do they actually exist? So you can see there's completeness, there's existence. Do you actually own them, if you like? So typically, I'm sure you remember the happy days of, well, when I say the happy days, I might have discussed factoring, where some businesses can sell their list of assets. It's not I mean, if they have, they should tell you. It's not the kind of thing that someone would wait for you to then say, oh, yes, by the way, we've sold our list of debtors on recourse, where we've either sold them and we're still recognizing them, or we've sold a certain percentage of them. They will tell you if they own them, which is why it's very small. There are not many. There's only 2 checks. It's usually, they would let you know. And we could go on, if you like, and when we look at this. But the key point here is that the audit plan is very much a detailed part of the detail is there, telling the auditor exactly what to do, what procedures to do. And this is for every balance, by the way, every balance, telling you exactly what to do. Also, the plan is very clear, will tell us who is going to be doing them, and typically it'll state whether they're an audit junior or senior and what level they're doing it. So I talked about this idea about interim versus final. So sometimes, typically at interim audits, so when I drew my timeline here, we had December, I would argue, first of all, of course, interim audits, controls testing happens here. So we come in and we review the controls again, just walkthroughs. So we're not actually looking at any evaluations. I just want to know to what extent I can rely on the controls. And also I could sneak and do some actual substantive testing on non-current assets and things like that, because I doubt those are going to change, if you like, post the year end, right? It's the same audit, of course, by the way, that I'm doing. I'm just doing some work before year end, right? I'm just doing some work before year end. Any other procedures necessary to conform to ISAs? I can't remember any right now, but anything else? We'll see some. You see what I said here, how much work should be done, sample size is very clear, there's no joking around. And also you would have the materiality there so that the auditor is very, very much aware of what is going on. Cool, great stuff. And that, my friends, is the general idea with planning, if you like, and it incorporates everything we talked about. It incorporates kind of the ethics and acceptance and risk and materiality into the first bit of planning, into the understanding of the client, first of all. Then there's the actual audit strategy. What's the big picture? Where are all these warehouses? Where are all these? Do I need to speak to any lawyers? The thing is, like I say, this is real life. So you just almost have to think on your feet when you think about the balance, or you think about when you look at the management meetings that they're having. Are these people facing any contract issues? Are they at threat of even going under, if you like? So, because we'll come to that, all this question of, are they actually a going concern? Have they lost their financial director? Oh, all these changes. And then, of course, there's the actual audit plan of actually doing the work and timing it, if you like. So we would expect him to spend 2 days on it, because we don't want to leave there and someone says to you, sorry, I still haven't actually tested trade receivables completely. Okay, great. Right, so the chapter also in here also looks at fraud and error, and I'll just go through that quickly. Just look at the time, really important. Yes, okay, great. So looking at fraud, and this is again, I think it's when I say it's a nice topic, because you can hit the key points by understanding the premise here. And once you understand the premise, then you're there. In that, it isn't our job. Our job is to carry out tests of control, because we're taking a risk assessment approach. We're using a risk basis. We're not testing everything. We'll carry out walkthrough. We will look at controls. And if we sufficiently look at controls and we walk through, because I'm going to show you some sorts of things, some frauds as we go through this area here, and you'll see that it's if you can catch a fraud, you're very good. because if someone wants to be fraudulent, then they will be. It's difficult. So what is fraud? Let's go through fraud. So in an exam, you can get a completely separate question just on fraud, like a question like discuss. Oh, wait a minute. Yes, it's a written exam, isn't it? Yes. Who is responsible for catching fraud or something like that? Who is responsible for preventing fraud, if you like? And we'll see that here. Nice question as well. Nothing crazy. So what is fraud? An intentional act. It's intentional. It's intentional. And hopefully I'll open you up to this idea of what fraud is. Intentional act by management, those charged with governance, employees, third parties, involving the use of deception. I mean, fraud is it's wide, and so hopefully you're open to it. Involving the use of deception to obtain an unjust or illegal advantage. So there's two basic types of frauds. We can split fraud into two. So I have met a number of financial directors who don't think that massaging their financial figures to look favorable is fraud. I think that's a culture thing, but it's fraud. So because it's deliberate, if you like, so deliberately misstating the accounts, and we'll look at that. Deliberately misstating the accounts to make the company look better or worse than it actually is, if you like, is just fraud. So this is the one people tend to kind of accept is fraud. This theft, physical theft of money or inventory, and even you have scenarios where I've seen you will see it. Directors will buy inventory or will buy goods, so debit purchases, credit bank of the business. They will take inventory for themselves. So technically, we should see debit drawings and credit purchases, if you like. But they won't put that journal through. They'll just take it for themselves. So in effect, what you still have is this benefit to the director being put through the business. So basically the business is paid for him. That is fraud. Many things you have to spend time educating them that, listen, I'm sorry, that's just fraud. So the key point here is where the marks are here is that fundamentally, and you can also tie in, you might remember a while ago when we started, we talked about something referred to as the expectation gap. Some people think that we prepare the account. Some people think we are the ones who find fraud. The primary responsibility for the prevention and detection of fraud lies with those charged with governance and the management of the entity, not us. So the directors are responsible for this. And it's up to them. They can, have a risk. We don't really care what committee is doing it. Risk committee, audit committee, internal audit, just make sure you have controls in place that will prevent fraud. So it's less about, ultimately, to prevent fraud, you need controls, right? Because it's about people knowing they can avoid those controls. So ultimately, implementing an effective system of internal control reduces the opportunities for fraud to take place. We can go as basic as locking your stockroom, or having a code, or as basic as not allowing people to swipe their cards twice when they go into when they come into work, like in manufacturing. I know a lot of manufacturing is gone. In fact, now, I'm interested here. I like asking these questions because it allows me to compare. I don't know why. I'm not ashamed of it. I worked in McDonald's for 2 years when I was doing my A-levels. Did anyone here ever work in McDonald's or fast food? Anyone ever work in fast food?
No, Ian.
No.
Afraid not.
It's cool. There's just, it's just surreal. It's I think there's just too many posh people nowadays. I just feel there's just no real hardcore digging your hands into. I'm just kidding, by the way. But when I worked in McDonald's, we had these time cards that we would go in. When you go in, you get a time card, and then you put your time card in, and the machine records a time card, and then you know, at the end of the day when you're leaving, you put the time card in to record your time. And of course, as time has evolved, this has moved to these cards, you know, the cards that you swipe, and then records your login. I imagine definitely in practice, I'll go to Hannah first. Hannah, how do you keep a log of your day? Because typically you have to charge your hours to the client, right?
Yeah.
Right.
We use the system. We use Zero, so we've got Practice Manager. So every minute that our day is documented on there.
Perfect. Exactly. So we now have lots of new systems that record, if you like, wages. Now, what used to happen, definitely when I worked at McDonald's, I mean, I saw it, was you'd have two friends, they'll say to each other, listen, I can't come into work today, just put my time card through, if you like. So what you had, I mean, again, one way of control is at maybe every 2 hours, one of the managers would go around and get all the time cards, and because I worked in a big McDonald's. There's one in Croydon many years ago. So big one. So you can have lots of people in this big place. So and the manager might not know everyone at that particular time. Managers are changing shifts. So you have the potential for fraud there as well. You know, you have people sign, especially in manufacturing. I trained at the time when there was still quite a bit of manufacturing. So you have people clocking in to come into and then what you now had people putting cameras at the place. So these are all controls, having cameras. Hopefully you still see questions like that from the past, where there are cameras to watch and take pictures of people as they come in and they clock in and clock out. And if you like, so typically what used to happen was if you were having a lunch break, you would have to clock out and then come back and clock in again for the hour. So it's all very, there's fraud on many levels. Anyway, let's carry on. So again, also, of course, this question of, again, which is where I think audit is quite a fair paper, is that fraud isn't just about these controls. It's about a culture, isn't it? A culture of honesty and the fact that we shouldn't be looking for ways to defraud the system, if you like. So a culture of honesty, ethical behavior, and active oversight by those charged with governance. So it's the kind of thing you must have, and you should have training in place to kind of tell people this is the culture we want, and as well as having, but the key point is, even, I mean, we'll see that slide in a second, even having an internal audit department in place is enough. People know that that we have a department that potentially will review and check things from time to time. Taking property that belongs to the company is theft. I mean, I know people don't think a lot of these things, taking a computer that belongs to the company or a laptop, that sort of thing. Anyway, and so typically, I'm sure in your organizations, you have someone come around and check to see, do an audit from time to time of assets, little assets around the firm. So, and the audit committee, typically via internal audit, should and that's the job of internal audit, to regularly go through these controls to make sure they're working effectively. Again, like I say, this is normally in conjunction with the internal auditors. So internal auditors are typically it's a full-time. I mean, it's a role, you know, very much a very important role. So, so the internal auditors, their job is, of course, to test the effectiveness of internal controls. You can get a question, but it shouldn't shock you. You can get a question on the role of internal auditors. I've already talked about them working as sort of semi-experts with us and helping us to work and carry out some of our own controls testing. They're very much there documenting the controls within the organization. They document and training on those controls and testing the effectiveness so that when we come along, we can just use those controls and then carry out minimal testing. So if they're looking at the system and testing the system regularly, they should be able to. We're only there for 2 weeks. Even with an interim audit where I do some controls testing, I'm not going to pick up any of those. And I haven't even started talking about inventory, the controls for inventory, goods in, goods out, theft of stock, damage of stock. The controls go as far, because the industries are so different. I mean, you guys remember James? So you guys worked with James did PM with you, the other James, and he used to work for a company that made vaccines and drugs in Worthing, and they had to make sure the temperatures were right on the fridges, but they also needed really special codes because those vaccines were thousands of money. So lots of controls, if you like, in place. So internal auditors performing fraud investigations. Who would be responsible if there was a fraud? If there was a fraud, it's you. If there's a fraud, the business is responsible for investigating its own fraud, if you like. When we turn up, they should tell us that there was a fraud. So we then probably will spend some more time on that balance, so to speak, to see if there's we're just higher levels of professional skepticism, really. So it's up to the internal auditors to do all of this. It's not on our report. I mean, we would highlight the fact in our report that there was a fraud and make reference to this documentation, but we don't go out there investigating it. But on the other hand, that's not to say that we cannot receive a separate engagement and a separate assurance engagement to investigate a fraud, and we would just be giving their negative assurance. We would just be giving negative assurance because there's no standard for finding fraud. It's just a special investigation, right? So let's just look at a few examples just to put you into the context of fraud, right? Just in case you're thinking, oh, Ian, right, you say fraud, but what was going on? A popular fraud is to do with purchasing, procurement fraud. So like I said, you have the ability of, you might not think about it. If Dudley, for example, was close to the person who actually orders the things, and Dudley doesn't need to go through a manager above him to get it signed off first, because it's just about the size of the organization. This is all very possible. So you can have someone just ordering goods on behalf of the organization. And typically, before that thing is paid for, the computer is paid for, typically you should have someone, the financial accountant, request to see the invoice, request to see who ordered it, because it's maybe slightly, it might be a raw material, it might be a computer. We have fraud even at that level. So it's about having controls over procurement. False invoicing. Now, this is kind of another kind of a sort of issue here where I know, again, you would think, who would do that? Again, internally, people can speak to their friends or speak to people outside the company to send in an invoice, if you like, into the company to be paid for, as though the company had received some goods. So typically what you should have is that the financial accountant should check, if you like, before any invoice is paid for, they should check that to goods received, or the goods are actually received, if you like, to the order, if you like. So all those documents should line up before something is paid. So if someone can spot that there's a kind of gap in that test of checking from order, who authorized it, who needed it, the goods actually arrived, the goods where we can see a clear goods delivery note, it was signed for. Again, the question is, where is this fraud beginning, if you like? And then an invoice comes in, and it's put through and it's paid for, then we have issues there. Credit card misuse, I'm sure you see this in the news all the time. People, again, will use it in whatever shape you want to say, basically using the company credit card and not declaring what's been used. Manipulation in the procurement process. So typically what you have here is, there's many ways of thinking about it, really. The popular one that I have seen is that, imagine, let's just say, go to James. James is the FD within the business, or is in procurement. James is the FD. No, that's actually for the second one, for the last one, receiving kickbacks. So James is in procurement, or has access to that level, and what he does is he sort of says, he goes out there and he has to do a tender, and he goes out there and all the goods are the quality they actually want, it's worth £10 per unit or whatever of raw material. And James says to him, finds a cheap supplier. He says, okay, listen, how much is this? The guy says £5. He says to him, okay, you know what? You send me an invoice for £10. Still supply us, but don't sell it to us for 5. Sell it to us for 10, right? When we pay you the 10. I mean, so the goods actually come in. They're just goods that aren't worth 10. and the goods come in, and then what happens is the James later on shares the money with that character. I mean, I'm just joking. I'm not saying you do that. I'm just saying that it's just the nature of that transaction. So there you are. Kickbacks, again, kind of similar. Again, kind of working at that higher level of getting contract work and giving it to your friends. General theft. Again, sharing information that shouldn't be. Removing and selling inventory. This is very popular in many organizations. Cash, I don't know, not so much, because I don't know. I mean, well, what am I saying? Definitely, with more and more cards and contactless, this is less, but definitely corner shops, and they still have a lot of cash. Very easy for cash to go, if you like. So, yes, I think I've talked about this: fraudulent acceptance of goods and services, receiving compensation without reporting, if you like, the transactions. So sometimes you get, what you have here is that you just totally ensure that the transaction never shows in the accounts, but the money comes in. So you sell, if you like, sell something, and the money comes in, and somehow but this is quite high level. The financial accountant is able to deviate the funds and pretend the sale never happened. So we've bought goods, sold the goods out to someone, and we've received the money, but the money is not showing on there, but yet the expense is showing. So you can imagine the work of an auditor is really difficult, trying to catch these things. How do you know that the third party that we bought the goods for sold it to us for £5? All you're seeing is an invoice that says £10, and that's what's been recorded. We've paid £10 out. That's fine. You don't know. You can't know this level of fraud. Payroll. This is the best one. I'll tell you a story. It was literally 1 minute. On one of my first audits, I had to do, well, maybe second. Probably first or second. I was asked to go along. So with payroll, one of the tests is to actually, again, like I say, this question of existence, actually see if these people exist. So imagine you had a payroll of 10 people. I mean, there are other tests in terms of the amount, but you want to see that you don't have any ghost workers. So this idea of fake employees on the payroll, very, very popular, used to happen a lot. I'm always concerned whenever I notice, I mean, okay, no. Yeah. James came through Chichester, in Chichester, right? And it happens in our finance department. I mean, I joke about, I always tease them a lot, and they always laugh and say that you're the only one who ever asks such a question. Our payroll director and the finance director, are so close. They play football together. They go home together. They support Liverpool. They go to Liverpool for the games. Whenever I see them, I always shake my head and wag my finger. They're always laughing. They say, "No, we're not doing anything." I'm like, "I'm sorry," because this is an issue here, because the payroll guy, he can put people on. The FD guy authorizes the payments. So and I always ask, so who checks you guys? As a HR. So they have a HR lady who acts as their kind of she checks as well. But this scenario was, I was in this engineering firm. I think it was in Leeds, and there was I saw a name on the payroll, and the name was John Doe. And I thought to myself, that's got to be a fraud. No one can be called John Doe, because I remember John Doe in all these stories. John Doe was like a name you just used, like, oh, imagine a character called John Doe. So here I am. I walk down. I say to them, oh, you see this? I say to the lady upstairs, this John Doe guy, where can I find him? He says, oh, he's downstairs in engineering. So I go down to this massive room. So imagine that's the door, and people are working here like this, and John Doe is sitting here, and I walk in and I see John Doe, and I walk to the room, and I see someone, and I say, I'm looking for John Doe, and they say, oh, he's over there. And this old man turns around and looks at me. He says, yes, I'm John Doe. And everyone here starts laughing, and they say to me, don't worry, you're not going to be the first. Every audit has been coming down for the last 10 years. That as soon as they see John Doe on the list, they come down and look for him, just because his name is so, if you like, obvious. So this is another kind of audit. This is another one that I've also seen as well. Definitely, I remember seeing a payroll lady who had gone off on holiday, and somehow she had been, no ghost workers, but what she had been doing is she had been putting extra overtime, if you like, for her friends, and they had been sharing the money. But because she was on holiday, somehow, and it wasn't that they found it, they just found an email from one of the ladies who didn't know she had gone on holiday saying, "Did you put it through this month?" And they asked her what was being put through, and then she started panicking, and then they carried out a full investigation, if you like. So all kinds of frauds. So like what I was saying here, accounting fraud in terms of reporting manipulations, we could go into those provisions and things like that. Numerical performance. So what I was talking about today, because these ratios, all manipulation of ratios in order to gain success is fraud. You see this is incentives to misstate statistical and financial reporting to meet targets, if you like, all considered to be fraud. A lot. The other big one is money laundering. I talked about the restaurant work that I saw. Definitely. So this is how they worked. This is how those guys worked. So they had, I mean, I don't have a problem with laundrettes. Most laundrettes today actually quite honest. This people had laundrettes, restaurants, and they had what's the word? And they had these pool bars. And what they also had was they had these I wouldn't call them strip clubs, because that's a bit too strong, because they weren't as posh as that. So think about it. They would have all their illegal activity, and all you have to do is just feed the money into the buy cheap. And what they also do, they buy I guess I'm just showing you all the models. They'll buy cheap booze, right? And they'll just buy a lot of it, if you like, and have all these so-called discounts or whatever. And so you would have, and the reason how I picked up most of them, we all picked this up, is that most of these restaurants would be quiet during the week, Monday to Thursday, busy on a Friday and Saturday, and then quiet again on a Sunday. But they'd be showing turnovers as though they'd been busy for the whole week, heavy turnovers. So then they'll basically put all the money through here, and then or wash all the money through the pool bars. All the money will wash into the restaurants. The restaurant was the key wash. All the money from here would wash. Well, money would wash into the laundrettes, and that would wash into the restaurants, and then from the restaurants it washed into property, and then it became clean, if you like, and they became legit. So lots of ways. I mean, even tax evasion, if you like, but. Anyway, and then of course, like I said here, economic activity that is not taxed or monitored by the government. So the key point here is this whole trying to move money, clean money, basically. So how do you do it? Typically, this is traditional. Typically, internal auditors can typically carry out asset counts regularly. Just having one acts as a deterrent, if you like, in itself, for the prevention of fraud. So what our job is, if you like, is to understand, if you like, that misstatements in the financial statement can arise from either fraud or error. So the fact is that, well, the difference between the two is whether or not it's intentional or unintentional. And of course, we should be able to find material misstatement. We should. I mean, we should be able to find some material misstatement. Again, like going back to the trade receivable entry I was giving you, just by looking. If you think about it, if you look at all the trade receivables over 30 days, 60 days, and up till, if you like, where we are, Mr. A, B, C, D, you might have something that looks like that. Right? I mean, that's what's showing on your statement of financial position. That's the figure there. So I should be able to investigate what's happening here, you know, and understand. And then I'll show you some further testing. So, I mean, it's by carrying out good planned audit, you will find some material misstatement. You won't find, again, finding fraud depends on the skill of the people who are performing it. So you can see how it's very unlikely that I'll find fraud, but I'll find material misstatement. And fraud actually occurs with very normal transactions, you know. So how do I know a normal sale is a fraud. I can see the invoice, I can see the money. How do I know? But what I can do is make sure I look at controls, and so I have some responsibility in considering the risk of material misstatements. You can see here, risk of material misstatements due to fraud. So what am I doing here? I'm assessing the risk of material misstatement due to fraud, and I'm going to respond to those risks. So I'm trying to obtain reasonable assurance that the financial statements are free from material misstatement in general. So I am alert I am to the possibility that fraud could take place. If you like, I'm just alert, really. That's all. I'm just alert, if you like, to that possibility. And also, again, like I say, it's all about controls. So if I observe that management regularly override controls, and we'll come to see when we talk about controls, if I notice that there's very little segregation of duty, because you would need, if my aim is to prevent two people who could collude from colluding. And it's harder to have more than two. Once you have three people colluding, then that's a big fraud. But typically, if you can prevent the two people who could actually connect, then it's easier to prevent fraud. So, if you like, yeah. So our procedures in themselves, because all I'm doing is looking at those controls, and if I can see that there's a lack of segregation of duty or there's easy management override, then I can accept that, right, there's potential here for fraud. Again here, if I notice that there are a lot of profit-related bonuses and applications for finance. Remember, fraud isn't just about theft. Fraud is also about, if you like, not recognizing or, if you like, overstating intentionally figures in the accounts. So that's fraud as well. So if I can see there's pressure, if you like, on your statements, then I know that there's potential fraud. So again, little things. I'm just looking at the environment, ineffective internal controls. And if I see that there's management don't really care, they're not really really aware, and everything I've asked for when I put that management letter together with the controls, they didn't implement, if you like. And then typically we also ask management to sign a letter saying that they don't know about any fraud and that they're responsible for fraud, if you like. So again, so are directly, are you aware of any actual or suspected fraudulent activity, if you like? And so typically I'm hoping they will help me out and tell me. So inquire of management and consider those relationships during analytical procedures. So the other reason I talked about this, I started off this class with Natalie's piece, was that analytical procedures should highlight issues. They're about making you suspicious. So if on one year my GP margin has suddenly gone up from the next, well, it's not that I think there's fraud, but I become suspicious, and I think that revenue is overstated, and I think there's the potential that from a reporting point of view of fraud, not from a theft point of view, if you like. So this is more reporting fraud, but it's still fraud. So that's why analytical procedures are very helpful. So they help me pick up on this. Okay, great. Well done. I hope you're with me. I'm just going to carry on. So typically, some of the things I can do, if you like, is a big journal. I'm sure you'll remember it, is the general journal. Most organizations still have something of a general journal. They might not call it the general journal, but it might just be the journal list. Or the adjustment journal, or just where all the year-end journals occur, so to speak. Depreciation, all the things that just won't naturally flow through our typical five journals, our day books, and of course all the non-current asset purchases. I mean, and there's still frauds that I still don't. I mean, I'm just going to put my hand on heart, just because fraudulent people are very clever. I mean, sometimes you just cannot understand what they're doing. So, and now, I mean, when we start talking about financial reporting, there are lots of other financial instruments that are at play now that you would need to understand the industry to really understand if there's a fraud or not. Okay, great. So what are we talking about here? So what you want to do is you want to be able to look at that general journal, look for potential manipulation of figures, unauthorized journal adjustments, review management estimates for evidence of bias. Remember, fraud isn't just about theft of money, it's about financial reporting. Review transactions outside the normal course of business for unusual financial reporting, fraudulent financial reporting. And finally, get from management proof, written representation that there is they aren't aware, if you like, of any fraud or any events, any suspected fraud. And we've kind of looked at those two. Again, journal entries and adjustments made at the end of the reporting period. And just really looking at, typically this is where someone might put through a big provision or something at the end of the year, or something, fit it in during the year to kind of make a figure look better. Yes, we've talked about all of this, basically looking at all these judgments, because this is the problem with financial accounting, isn't it? Judgments. I think I've already highlighted that once, in terms of materiality, once a situation where we're in profit, if an adjustment, if you have an adjustment, for example, in the general journal that you're not happy with, and you decide to remove that adjustment, and it goes from a profit to a loss, then we have a situation of materiality. That journal is material, right? It doesn't matter, even if it's £1, it's turned a profit into a loss, because the whole idea was that initially things were a loss, and now they put that journal through to make things look like a profit. So we are suspicious of manipulation straight away. So we start investigating other things, if you like. Yeah, so again, yes, I've talked about these already. Yeah. Yes. I think this is the important thing. Management are very aware. Management must acknowledge that they are responsible. We've highlighted this for controls, detecting fraud, and again, like I say, that typically internal audit would have been carrying out risk assessments throughout the whole period, any known or suspected frauds, and any allegations so far. But again, it's still possible that there might be, it's still possible that there might be a fraud, even with all the good work that we do. If we do find a fraud, we should straight away tell, depending on where the fraud is and at what level it's at. But really, the financial director is enough, and it will depend on the size of the fraud and the type of the fraud, and that will determine whether or not we want to qualify it. But the fraud in itself doesn't mean we qualify the accounts or say the accounts are not true and fair. Remember, the fraud could be, a fraud is a fraud. Even a fraud for £1 is a fraud, if you like. It's still a fraud, but it's bringing to that attention. And if, again, depending on the level of the fraud, it means we might have to go to the board if it involves the financial director. I've never had anything severe where the financial directors are involved in fraud, but I'm sure others have. So it's about who is the highest level to communicate this information to. And apparently, if it's even higher than that, then you should seek legal advice, because you think that, and that fraud could be this. By now, it starts to look like money laundering, if you like, and that type of thing. If you can't even trust the board, because it must be quite big. Yeah. So this is, again, like I say here, whether or not we need to be talking to people on the outside, and bringing in the lawyers. So yes, in these circumstances, it's really best to seek legal advice. Again, like I said here, if the fraud has a material impact on the financial statements, then we'll modify. If it's just £1, then but if it's again, it's about materiality, right? Because that's really still material misstatement due to fraud. Yes, material. We're looking for material misstatement due to fraud. It's still about the materiality of the misstatement, if you like, which is a judgment thing. So you might consider it, the extent to which you consider it, if you like, a judgment. Right. Okay. Good. So we'll spend the next 30 minutes quickly tying up this bit of the. Let me just see how many slides I have. Do punish. Okay, that's not. Oh, that's not too bad. I can get through this one now. Right. So typically, this isn't new, but what we, as part of our risk management as auditors, what we have to also make sure is that it's again, like, it's really from a risk point of view, in terms of disclosures, and from a point of view of disclosures, if you like. You see, because in of itself, for that year, things might be okay, but for the next year, there might be issues. So, for example, construction. Let's go to construction, for example. Now, the construction industry doesn't just, they must follow certain guidelines for their workers, protection, health and safety. They must pass certain standards within their work. And if they don't, and they must get certain certifications for those workers, if you like. So from an audit point of view, it might not seem like it's our business, but here's the thing: if they fail those certifications, if they don't get those certifications, then they might lose their license to work. And as a result, they will lose their trade. And therefore, it becomes a matter of going concern. So it's less about the figures for the year. It's more about the continuance of this organization. So management are responsible, but for us to sort of say that there is the going concern potential here is fine, we need to also spend some time on that area. So typically, it's not our responsibility. Of course, it's not. It's management are responsible for ensuring the entity complies with the relevant laws and regulations, including, of course, company law and this US SOX, sort of for short, Act. So when we had, if you might remember, without taking too long, when we talked about corporate governance, and we took the typical corporate governance where we had the problems with Enron and WorldCom when they collapsed. In the US, you had these. That was around 2001. 2000. In the US, you had these two senators come together. I've forgotten their first names, but these are their surnames, who now said that every single listed company must have an internal audit department, 100%. And not only must you have an internal audit department, but the financial director also has to sign that the accounts are true and fair. So almost like taking personal responsibility. So there were a number of new acts and new laws that came in, if you like, that listed companies had to kind of follow. So a very clear internal audit department, if you like. And so these were things that, so we're just looking to see that these people have abided by these laws, if you like. Because remember, like I say, we're really acting on behalf of investors and shareholders, really, to protect their interests. So, for example, like I said, health and safety law, employment law, and I mean, this employment law is big. I guess the question is to what extent. But there is so it's almost like having that sit down. Typically, there's a questionnaire, if you like, and we're also looking for things in the news, because again, like I say, all you need is for one whistleblower, and an organization could literally collapse, if you like. So these are some of the issues that we need to think about. I mean, this one is more in our area, but there are other sorts of certifications. So the company has to go out and get someone to come in and audit them, which is specific. So like an employment lawyer, they have to get signed off, health and safety. They need the health and safety people to turn up and inspect their kitchens and inspect whatever it is, inspect their workplace. So all we need is the evidence that has been done. We need the evidence that you have abided by those laws and regulations. Yeah. So again, we just want to make sure there are controls in place HR probably, to ensure compliance and effective system of assessing those controls. So like I say, this could have a material impact on the financial statements. So all we're trying to do is obtain sufficient and appropriate evidence regarding compliance with laws, if you like, and regulations. And typically and typically you need to provide disclose that you have in your financial statements. This is typical, and that you make those disclosures as well. So like I say here, data protection. I mean, I'm thankfully we all lived through suddenly I don't hear anything more about GDPR. You know, GDPR came and terrorized. I even remember it was May, I want to say 25th. There was this big thing about GDPR. Now I don't even think I've heard anyone mention GDPR for such a long time. But to be fair, we are much more aware of what's going on, GDPR. So typically, typically, if this is law, I mean, many companies are doing what's referred to as triple line bottom reporting, where they are doing things even though they don't have to, because they know that the public are much more interested now in the environment, in public health and safety, but they don't have to, but they are doing things, and that's just for their own selves. But if your work requires you to do this, then you should. You can see I highlight here that non-compliance could affect the company as a going concern, and so it's important to kind of, what we have to do is kind of understand the framework and if they're complying with that framework. But like I say, typically, if you can't do it, you can bring in the expert. What am I saying? You don't even have to bring in the expert, depending on what it is. Typically, it's their job to make sure they're complying with that framework. Yeah, and again, like I said here, we inquire and we get the information, and that's not too tricky, to be fair. You know, we're literally the correspondence. We're asking directly for the correspondence, inspecting correspondence, if you like, with the relevant licensing and regulatory societies, and just being alert to any non-compliance, looking in the news or looking in the press. And obtaining, again, so I know I talked about a management letter. Typically, I'll talk about the quality of this evidence. We have different qualities of evidence. Evidence that you find yourself is the best. But when you can't find, what you can also do is you can get the directors to make a written representation and say that, yes, we also tell you that this thing exists or this thing doesn't exist. It's the weakest form, but it's there. So at least you don't have the liability, but the directors do. So that's what's happening here. The directors can actually disclose and say, listen, we are aware that there's nothing, if you like, you don't have any, there are no issues, we are compliant, that sort of thing. Right. So again, what are we doing? Again, just summarizing very quickly, we're inquiring if there's any non-compliance, then we need to make sure that all of this is documented, it's disclosed, any penalties have been put through, accrued for, and trying to understand what the consequence is, really. You can see here, inquire of the company's legal department as to the possible impact of non-compliance. So typically, I think I've said it several times, board minutes are legal documents. You know, a lot happens in a board, and typically you'll be in a board meeting and you hear someone raise their hands and say they want to talk about this off the record, or they don't want this to be on the minutes, because the person taking the minutes has to record absolutely everything that they hear as much as possible. And typically, I mean, if there is non-compliance, then again, in the same way fraud is done, because it's not, all we're interested is this question of going concern. Now, will it affect us? Is it material for us? It could be part of our controls. We just want to let governance know that, listen, guys, you need to be compliant because this can affect you. But then again, the question is, how material is it? There's a range of things, you know, that when we come to this question of non-compliance. Again, like I highlight here, if non-compliance has a material effect on the financial statements, then of course we give an opinion. We'll talk about opinions later on. There's no rush, but the key point here is that how far do we need to go in reporting this issue of non-compliance? If we feel there's a third-party effect that if you're dealing in a drugs company, and as a result of I mean, we're in that situation right now in the NHS. You and I know this question of them not getting enough protective equipment is an example of non-compliance. And of course, if the NHS was a private company, they'd be in a lot of trouble. It's just that it's just difficult. Right. Technically, I believe the last bit for today is quality control. And I'll summarize it, but I'll go through the slides really quickly, but summarize it. The key point here is that we as auditors need to make sure that we are self-regulating, right? So because we are independent, so the argument is that someone needs to be checking, or we need to be checking up on ourselves that we are giving the right audit opinion. Because think about it, you have this independent senior partner who comes in, he does the work, and he says that, oh yes, by the way, the accounts are true and fair, and that's it. If you like, all these people are relying on the work of this one individual who's checking the auditor. So really what you typically have is, depending on the intensity of the audit, if you like, one, and two, in how do we know that the auditor picked the right people? How do we know they were the right grading? They did the work well? How do we know? So really, how do we know the work was done well? So all this is what this whole idea of quality control really is about. But it's really about us self-regulating ourselves. So quality control must really happen really from the top. We must consider any relevant ethical requirements. And quality, even at acceptance and continuance of these relationships, there must be quality control. Should we carry on with certain clients, or is a senior partner? Remember, partnership in accounting firms are typically partnerships. So I know they're LLPs, but you still have senior partners who come with their own clients. So you might be endangering the entire firm if you're carrying on with a client who we shouldn't really be with. So quality control is very much about getting the right people on board as auditors who are qualified and who are being trained, if you like, so that they can take their theory into the class and they can have good experience. And we're also, of course, looking at the engagement and monitoring their work. So in terms of the process of an audit, like I mentioned, you have this person, an engagement partner, who takes over the actual audit itself and who has managed, if you like, the ethical requirements during the engagement. And of course, we followed the right acceptance. Everything we talked about, we follow the right acceptance and the continuance procedures. And also, like I said earlier on, the use of experts would have been organized or dealt with either by the audit manager and the audit engagement partner, who would have been in charge of the process. So so the engagement team and the audit experts used have the appropriate competence and capabilities. So this is all very much part of making sure we have the right people. Reviews, all the work has been reviewed by an audit senior. So everything is reviewed by one level higher. Audit senior reviews audit juniors, audit manager reviews audit seniors, audit engagement partner reviews and audit manager, if you like. So and so we sit down and we sufficient evidence has been obtained. So that's the other thing. So the engagement partner wants to check that you have found sufficient and appropriate evidence, right? You've taken big enough samples, your materiality worked, if you like, if it had to change, you've changed it, you've looked at the controls, because we want to make sure we give the right opinion. Again, just making sure we comply with the code of ethics, right from the ethics, from the planning point of view, all those things we talked about in whether or not we should accept a new client. Again, this all goes back to that matter of, should we accept a client? What's an acceptable level of risk in relation to fee? This just kind of goes back to that in terms of our own reputation. And Yeah, I think this was all just kind of, this is just regurgitating everything we talked about. That's the other problem. Sometimes this just kind of goes back in loops, but just highlighting the big points. Any significant matters during the previous audits have been reviewed. So that management letter I showed you guys was really important, that that we get the directors to actually act on those controls. And if they do act on it, then we can carry on. It gives us an indication that we're working with people who want a good audit to be done. Yes, I mean, this is repeating itself. Engagement partner is in charge. The people on the team know everything about they have the relevant knowledge, or we should educate them. So typically what happens at planning is that before the planning meeting, you would have the audit manager you'll get a file, you'll get a copy of the file, and you'll get a copy of the organization. So you read up on the organization the night before, 2 days before. So you all come into the room. It's a bit like what happens in these police crime scenes. So everyone sits down, and the audit manager, so the audit manager sitting down, engagement partners in the corner, and then you have the audit manager going over the job and talking about the organization, if it's a new one, and everyone kind of can see everything on a screen, and he'll kind of then hand over to the audit senior, who will talk about how he plans. They'll basically talk about the spread of the work. So you really have this you should have this constant relationship going on between all the parties, if you like. Key point, same thing: direction, supervision, review of the engagement, if you like. Yeah, it's somewhere I'm trying to get to quickly, but and all of this I've highlighted here. Again, yes, tracking the progress of the audit, significant matters. I mean, things can arise as you're going along, and sometimes you need someone as high up as the partner who can push. Maybe you're trying to gain access to some inventory, you can't get it, or you're trying to find a manager, you're trying to find directors' wages, that sort of thing. So the engagement, the engagement partner is always very is on the ball, is always is very aware of where the issues are. Again, like I said, if you lack any expertise, you can bring in external experts, and in time, that's very, very normal. Right. Yes, and the thing was that, yes, this is the last bit I think that I wanted to highlight here. So typically there are certain audits that are high risk engagements. That's the other thing that you want to be very aware of. Think about a small audit, okay, that's not too bad, but imagine a listed company, or a company with very high inherent risk, or a company where it's our first audit. There is a risk. The risks of audit, the risk of giving the wrong audit opinion are much higher. So when they're listed, when they have covenants to fulfill, so quite high risk. So typically what you need is an engagement quality control review, if you like. And really the key point here is that we should, well, a number of things here. So discussion of significant matters. So we typically, we would raise, when we come to see the audit report, like I said, if there was an issue of covenants that need to be met in the year of the audit, that becomes a significant matter. Just means that we're raising up those particular issues again. If there was a going concern matter last year, we might want to raise it up again. So we just have these matters that we just want to make sure we highlight again to talk about. So we have another review of the financial statements and the reports. Again, those significant judgments, the conclusions informing the audit opinion. Like I said, for listed companies, we want to see the independence of the engagement team. Any matters where there's been a difference of opinion. Yeah, and finally, as part of that engagement quality control review, we also want to refer it to an independent review partner. So we want another partner to come along and look at the quality of our work. So now, so typically, like I said here, when you have listed companies and companies that are at risk, we would always have what's referred to as a hot review. Right, I'll come back to a cold review in a second, but so oh, that's good, they're here. So the hot review, right, typically, like I said, for listed companies, companies that are at risk with significant judgments, and we want to make sure we get it right. So before the audit report is signed, you have another person, another partner, have a look at things. So he literally closes in and looks at all high risk clients and listed clients. So he considers materiality. Was it the right one? Should it have been lower? Were we independent? He looks at that management letter for the uncorrected misstatements. He looks at the audit, or she looks at the audit opinion. And this is, again, like I said, conducted by an independent partner of suitable experience. And if issues are identified, then they can deal with that. And that's the typical type of review you see, a hot review. And that's quality control, yes, self-regulation. Now, apart from that, after the audit, it could be 6 months later on. Typically, what you have is that you have another partner. Typically, this is outsourced. Someone comes from outside entirely. And just to ensure the firm's quality procedures in general, he or she will take a selection of completed audit files and just look at them, see if they were reviewed, they were signed. They're not actually looking at the work per se that was done. They're just trying to make sure that the process was good. The process of carrying out the work was good. They look for sufficient appropriate evidence, and all matters were resolved. So they're not doing the same kind of level of detail that the pre-issue hot review would take. But typically, I mean, it says you can have someone from the firm's own compliance department, but typically you can have an external consultant. And if there are issues, just more training for staff and arrange quality controls. But this is internal to us as an organization. Right, and finally, I keep saying finally, auditors are required to prepare your documents are legal documents. You keep your files. Because they provide the basis for your audit opinion. Again, because if you're taken to court that you haven't done this work well, you want to be able to keep your work and take it to court and say, listen, you've done it in accordance with the international standards of auditing, if you like. And of course, this is used for next year. It helps you plan the audit. And really, it's a legal document, and we need to keep it for all the rational reasons, if you like, for future audits. And it's a document, and it holds us, if you like, accountable. We want to keep good documents so that, for example, I can come in the following year, or you can go in the next year and just be able to refer to it, if you like, and use it. So we want to make sure that the work is of good standards, that the evidence collected is sufficient and appropriate, and we can refer to it and then build on it, if you like. So I mean, a lot of this, I wouldn't say you don't need to, if you like, typically remember it, but I think it's just understanding that you want to be able to keep evidence, if you like, that can be used for the future. Okay, well done, guys. That was a hell of a lot of slides. But that's the nature of this thing. I'm trying to do it in line with your textbook. So your textbook does have that number of that amount of material in that chapter. So what I recommend is that please go away and just make some notes, your own notes on chapter 1 to 6 now. Yeah, I think that's a good idea. I'm almost thinking that, and please, I mean, I know you're busy, but just take your time and do. I mean, I know I've not been the fastest as well. Sorry, it's just, but things are slowing down now, so I have some more time. It's this sudden homeschooling combination, because as soon as I finish this now, I'm literally supervising 2 little people till 4 or 5. And then so the time just goes, you just crash out. So I will mark, but I think it's good if you just read through the chapters, and then what I will do is send you the relevant the relevant exam questions through during the week. But what I think is a good idea is make your notes first. There is no rush. I might go into audit evidence next week, or I might just get us to do, if I don't, I'll just get a list of questions for us to do in class, just to get our heads around the questions. There's no rush. I think we should probably spend some time doing just questions. So we might do that next week. Or yeah, I'll see the balance. I don't think there's any need to rush. I think it'll be good to get our teeth into audit evidence and just get our teeth into some of the questions that we see in the exams on the first six chapters. But I'll send you that information for my plan for next week's class. But try and start putting your notes together. I hope that's a good idea. Cool. Is that good?
Yes, thank you.
Yeah, thanks.
All right.
Owen.
No worries.
Thanks, Owen.
No worries. Thank you. Great stuff. Have a nice weekend.
And you.
And you
And you.
too.
Cheers.
Thanks, Owen.
Cheers. Bye-bye,
Thanks,
guys.
everyone. Bye.
Bye.
Bye-bye.
Bye.